It's 9 a.m. live from the Nasdaq market site in New York City. Happy Friday. I'm Shauna Smith alongside Dan King Hall, and this is Yahoo Finance Live. Here's your morning rundown. Inflation persisting. The Fed's preferred measure of inflation, PCE, coming in slightly higher than expected in September. And consumer spending also surged, keeping the pressure on the Federal Reserve ahead of next week's meeting. Markets, though, are largely anticipating officials will keep rates on hold again. But the data does raise the prospect of more rate hikes in the future.
Meantime, Chevron and ExxonMobil both reporting profits surged in the third quarter as oil and fuel prices climbed. The results coming just after both Chevron and Exxon announced major acquisitions, doubling down on fossil fuel investments. We'll dive deeper into that later in the show.
And AI is the future for Amazon. The company's cloud business revenue coming in slightly below expectations, but bullish commentary from CEO Andy Jassy around AI got investors excited. It's been a mixed week here when it comes to the cloud results that we're getting across the tech sector. And that's why Jassy's confidence that AI could bring tens of billions of dollars to Amazon's cloud is striking a chord with investors. Let's start the morning driver here with one of the top stories of the day, and that is a slow start to the energy earnings. We're hearing from some of the big oil giants out this morning. Oil and gas producers ExxonMobil and Chevron both reporting quarterly results before the bell. Both, though, missing the street's estimates for the third quarter. And taking a look at some of these numbers here, this comes after Exxon and Chevron recently announced mega deals doubling down on fossil fuel investments. Those deals worth a combined total of $110 billion. Now, the reasoning, the rationale has been brought up a couple of times here on the street, Diane, when we take into account the fact that we're seeing this massive shift to, or transition, I should say, to clean energy. Yes. Why then is big oil doubling down on their fossil fuel investments? But what stuck out to me in this report was some of the commentary actually that we're getting right now. Exxon holding its earnings call, and from CEO Darren Woods, he's making some comments just about some of the tailwinds that he saw during the most recent quarter. He also points to the fact that it's fundamentally strengthening the earnings power of the company going forward. In terms of why, though, that Pioneer deal makes a lot of sense, Woods saying that this deal is a win every way you look at it. He also went on to say that it's good for shareholders, it's good for U.S. energy independence, and also the environment. The company also expects $2 billion in synergies from that Pioneer deal. Of course, we also had the massive deal Chevron announced earlier this week with Hess. So lots of questions. That call is going to get underway in a little bit later this morning. But lots of questions. It's about what exactly that's going to do for the business and how they see that shaping up their future investments going forward.
And it's interesting to see the market reaction already in terms of how Wall Street is responding to both Chevron and Exxon, right? You're seeing Exxon get a little bit rewarded right now in the pre-market, whereas Chevron is ticking lower at the moment under some pressure ahead of its earnings call. TD Cowen out with a quick take on its results ahead of its earnings call, talking about the primary investment risks with regard to Chevron, the oil and gas exploration and production industry. We know it's one of the most volatile industries. It highlights that, saying it's unpredictable. Obviously, you have that unpredictability factor that comes into play when you think about the geopolitical crisis that we're dealing with the war between Israel and Hamas. So that can play out in terms of the ripple effect within that industry. But we will wait to see what they say with regard to their earnings call and what the challenge is. And we also know when it's the case, when you have an acquisition come into play, often the share price of the acquirer gets punished. So that might be something that's occurring here. But right now, in terms of their miss, Wall Street is like, no deal. We're out of this one, at least in the pre-market.
Well, yeah, Chevron's deal to buy has, when you take a look at this earnings report, just in terms of where the production increase is coming from for the most recent quarter, most of it here coming from the PDC energy acquisition, which really points to the fact that the remainder of its business was essentially flat. We didn't see much growth. So that, of course, would then support the need and support the rationale behind management's decision to pay over $50 billion for Hess earlier this week. So we'll see more commentary, what we hear from executives, from Mike Wirth on that earnings call that's going to get underway later on this morning.
Yeah, it'll certainly be one to watch when we hear from them. All right, meantime, Microsoft's bet in artificial intelligence is paying off. After pouring money into its AI efforts, including a multi-billion-dollar investment in ChatGPT developer OpenAI, the tech titan came away the winner of the cloud race this quarter. Now, Azure and cloud services sales growth surged 29% in the September quarter. Its intelligent cloud business brought in over $24 billion. But Amazon is still staking its claim on AI. While AWS fell slightly short of analysts' net sales expectations, sales were up 12% on the year. For a deeper dive into Amazon's results, we're joined by Arun Sundaram, CFRA analyst. Arun, thanks so much for joining us again today. So let's dive right into Amazon's results. You saw the stock kind of flip-flop in terms of the reaction, and in the pre-market it has been higher. What do you make of its latest quarter?
Yeah, thanks for having me. Yeah, no, I think the story of this quarter is really that Amazon is turning to a highly profitable and free cash flow generating juggernaut. If you look at this quarter, operating profits hit $11.2 billion. That was well above the 7.7 billion estimate, and that's actually a over 300% increase from prior year, and about a 45% increase from Q2. And the best part is that there's still a lot more efficiencies left to be unlocked for Amazon over the next, I would say 3 to 5 years. On the e-commerce side, Amazon's still finding ways to reduce its cost to serve while also trying to increase delivery speeds. So really a win-win there. We'll likely see more robotics, automation in its fulfillment centers. We have its electric vehicle fleet coming in over the next decade. In Prime Video, I think there's a lot of enhancements left to be made there to improve the profitability in Prime Video. In the international business, it's starting to break even now. So I think going into 2024, we can finally see positive operating income in the international side, which would be a huge positive. And then lastly, with AWS, this quarter, we actually saw a 600 basis point margin improvement from Q2 to Q3 in AWS. And I think that's going to continue growing as well. So really the story right now is on profits and free cash flow. And I think that's what's driving Amazon stock higher.
Arun, how quickly you just mentioned AWS there, the growth that we're starting to see. How quickly do you see that growth then accelerating when we look ahead to 2024?
So yeah, I think the slight disappointment this quarter was that with the fact that AWS growth was it was 12%. So it was also 12% in Q2. So we saw pretty much flat growth Q2 to Q3. Investors really wanted to see that business reaccelerate like Microsoft did. Microsoft saw a 1 point acceleration from Q2 to Q3. I think if AWS saw 13% growth this quarter, the stock would probably be up much higher. But during the earnings call, it was pretty upbeat. Andy Jassy did say that AWS that they signed several new deals in September with an October effective date. So it seems like in Q4, so this upcoming quarter, we'll potentially see AWS growth accelerate from that 12% growth rate in Q3. So we could potentially see 13, 14% AWS growth in Q4.
I mean, there is some concern when you point to the growth that we're seeing or the growth that we have seen from AWS and comparing that to the numbers that we got out from Google earlier this week. Also, what we saw in Microsoft with its Azure business, whether or not we should be a little bit worried just about the risk there that the company is starting to lose more market share. What's your assessment of that risk?
Yeah, I know there's a lot of chatter about whether Microsoft is gaining more market share in the expense of Amazon. I think our conclusion is that it's way too early to tell. And it's really hard to tell because right now AWS is a much larger business than any other cloud provider. AWS is running at a $90 billion plus run rate right now, and it's growing 12%. So that's a massive business. Microsoft also has a big business, but not as big as AWS. And then if you go down the cloud providers, Google's cloud is much, much smaller. So you can't just look at just the year-over-year growth rates and determine whether one is gaining market share at the expense of others. All these new opportunities in generative AI and machine learning, we're still in the very early stages of that. So that's why, and right now it looks like all the deals that these companies are getting in generative AI, the deal volume is really lumpy quarter over quarter. So I don't think you can look at just one quarter and determine whether one company is gaining market share at the expense of others. This is going to be an opportunity over the next decade.
And Arun, let's hone back in on Amazon. You talked about efficiencies to be unlocked. What segments are you referring to when you say that?
Well, really, it's in the e-commerce side. The e-commerce business, wasn't profitable last year. Really hasn't been profitable for the past few years. And we're just starting to see that business become profitable. So it's been a few quarters now of positive operating income in that North America segment, which includes e-commerce, advertising, everything except AWS. And then one of the biggest reasons why we're seeing profit improvement there is that Amazon actually moved from a national fulfillment network to a regional fulfillment network. And by doing so, it's actually lowered its cost to serve because now you're shipping goods closer to the consumer, and it's also increasing its delivery speeds. So that's been a win-win there. And like I said before, I think Amazon's still very much in the early innings of improving efficiencies in its e-commerce business. I think over the next 3 to 5 years, we can see those e-commerce margins improve even more, especially as it rolls out more robotics and automation in its distribution and fulfillment centers, as it rolls out more electric vehicles in its fleet, as it finds ways to continue lowering its cost to serve. So I think there's still a lot of efficiencies left to be unlocked there. And then on the international side, like I said before, that business hasn't been profitable. And this quarter, operating profits in the international business was negative $95 million, which is a significant improvement from prior quarters, but it's still negative. And so the expectation is, as we go into 2024, that international business can start becoming profitable, especially as Amazon scales its presence in some of these emerging markets, which is still very much early in the whole e-commerce side. So we're positive on the whole operating profit, free cash flow story of Amazon. And I think that's what will drive Amazon's stock over the next year.
All right, Arun, always great to get your perspective, CFRA analyst. Again, Amazon shares moving to the upside here in the pre-market, up just about 6%. Another big story today, the Fed's favorite inflation gauge, PCE, out this morning, ticking up about 0.4% month over month. But for year-over-year core PCE, that cooled to its lowest level that we've seen since 2021, coming in at 3.7%, in line with the street's expectations. This is a positive trend for Fed officials heading into the November 1st interest rate decision meeting. We want to bring in Jeffrey Sherman, DoubleLine Deputy Chief Investment Officer. Jeffrey, it's great to see you here. So we're seeing a bit of a muted reaction here in the broader market on the heels of this inflation print that we got this morning. Do you think that it's enough here just to reinforce that the Fed should stand pat and not raise rates again at this next meeting?
Yeah, I think that's what it's really in line with the consensus, and that's kind of why you see a somewhat muted reaction in the marketplace today. Again, we're still in pre-market. Bonds are trading. They're a little off in yields, or slightly higher today, but this is pretty much a consensus report. What you find is you noted the headline number there, and that's really being driven by commodity prices. We've seen the change in oil over the last month or so. And so effectively, when you dig into like the core side, you look at the services, they are starting to decline, but really not as fast as the Fed would like. But it doesn't mean that they should continue to hike rates at this point. As we heard from Jay Powell at the last press conference, he's already saying that policy is tight today. And so a tight policy doesn't mean that we need to continue to hike at this point. You've seen deceleration year over year, both in the CPI measure as well as the PCE, which is their preferred measure. And so I think this is a welcome trend. I think that's what's really kind of calmed the market somewhat today, as we've had a lot of volatility in rates over the last 2 months. And so I think this is being welcomed on both the equity as well as the bond market today.
Jeffrey, what kind of messaging are you looking for from the Fed when it meets next week? What are you bracing for? What are you preparing for?
Yeah, Diane. Well, I think really the thing to look at is to kind of get what the signal is for the forward-looking policy. And the bond market really doesn't have another hike priced in. I know in the last statement of economic projections that we got back in September, that there was this dot plot that said, on average, or at least more Fed governors expect another rate hike than don't. But I think now that we're seeing this kind of trend in inflation, I think the right messaging is to pause at this stage. We know that interest rates take a while to get into the broad-based economy, and I really feel like we're just finally starting to see some of the impact on these tighter policies. And so when I look at the report too on PCE, there's a little disconcerting behavior in here. If you continue to look at this all year, we've seen an increase in spending that outstrips the increase in earnings on the income side. So this just means that there's effectively a draw on savings out there. And I know this has been something that the Fed is focused on, a lot of Wall Street is focused on, is this concept of excess savings in the marketplace. And so it seems that the consumer, although spending and looks very healthy, it's done so at an income growth rate that's not keeping pace with that consumption. And so, again, I think this is consistent with, commodity prices being up. When you ask the average person in the U.S., what's the inflation measure, they judge it by two things: their grocery bill or their dining bill, the food consumption, and how much it costs to fill their tank at the pump. And so I think that some of that increased spending we're seeing is coming on that side right now. And I know there's a lot of uncertainty about the geopolitical risk out there and what this ultimately means for the energy markets. And so I think the Fed needs to be patient. The Fed hiking rates can't curtail price movements and the small wiggles and jiggles we get inside of the oil prices out there. But I think if they look at the overall economy, I think it is indeed kind of slowing down to some of the metrics they're looking for. And effectively, I think that is rife for them to be able to continue to have this pause behavior. So we at Double Line really think that the Fed is close to the end of the hiking cycle. And really, if they hike one more time or not, the market is even less than a coin flip at this point. And it says not at the meeting next week, nor at the meeting in December at this point in time. And so I think the data corroborates that the Fed should continue to hold. And I think that the policy is tight, and we just need to wait for these effects to really slow down pieces of the economy.
So, Jeffrey, given all those uncertainties right now that you just mentioned, the rise in geopolitical risk, what that could mean for the oil market, we also have some worrisome signs that's coming out here from the consumer just in terms of their spending patterns. And we also have this massive run up that we've seen in rates. So I guess my question is, if you think it's enough here for the Fed to stay on the sidelines, at least for now, what's the probability, though, of a recession given some of the worrisome signs that we're already seeing before, or whether or not, I guess, regardless of whether or not the Fed is going to hike again?
Yeah, I mean, the recession, the probability of recession is not zero at this point. I know we're all going to celebrate the GDP report from yesterday, but I like to remind everyone that data is backward looking. We've seen the bulk of that data that led into that report. We saw that throughout the last month or so. And so effectively, that's a backward looking measure. And so when you talk about the consumer spending and income is not keeping pace with that spending, it is a bit worrisome, but it doesn't mean that we tip over into recession instantaneously. And so the pent up interest rate moves that we've seen over the last 19 months or so, as the Fed's hiked 525 basis points, that is starting to finally bleed into the overall economy. And we have a lot of fixed rate debt out there. And what I mean by that is, like, think about a mortgage. It's a 30-year fixed rate. Look at corporate America that did a massive debt refinance, a debt binge in 20 and 21. And so effectively, those parts of the market aren't as impacted by the interest rate hikes because that debt has already been structured out. It has a long tenor on it. But effectively, what you find is that if you're in the market now, you need to secure a mortgage. Mortgage rates are 8%. This is much more challenging, especially how high prices are in the housing market in general. And so we've seen an uptick in delinquencies. We've seen this in kind of the lower FICO cohorts, right? The lower credit qualities, we usually call it subprime. But in the auto side, we see it in some parts of the mortgage market that you're seeing signs that there are people late on payments and starting to miss more payments. And so I think this is part of engineering the hiking cycle. Capital is tighter, it's tighter financial conditions. And so what this does is this increases the probability. And so we still think that a recession is more likely in the next 12 months than not. But effectively, we're going to have to wait and see if this resilience of the consumer continues. And really all signs when it comes to a recession is what is going on in the labor market. And so all eyes will be on next Friday's jobs report to see what this activity looks like now that we have these tighter policies out there. And effectively, can the labor market prevail? Because we know a recession starts when the job losses really trickle through the economy. And so unfortunately, that's a bit late. That's usually a sign that you're already in the recession. But thus far, the labor market has been resilient. And so you got to keep watching. You got to watch small and medium businesses. That's where a lot of the job creation has been. And these are the businesses that borrow at floating rates, right? They're tied to prime rates. They're tied to bank loans, and they borrow from these small and community banks. And so those are the areas to watch for forthcoming weakness to see if this labor market is going to continue its resiliency.
And Jeffrey, I just want to quickly ask you something about, we've been really following the pattern with regard to yields. Have we seen peak yields?
Well, it feels like we're very close. If not, we've seen it. The 10-year has kind of tested this 5% level, and we saw it Monday in overnight trading in Europe. Then kind of when New York opened, we were like 501 on the 10-year, and it just really rallied from there. And so we pressed a bit higher intra-week. We didn't really get there. And so I think most people out there are calling somewhere between a 5 to 5.5% 10-year as being the peak. I think 5.5 seems a little rich. That we would actually get there, or too cheap in the market in terms of buying. And so far, I think it's a pretty good sign that we haven't really breached that 5% on a closing level on the 10-year. So The Treasury market, irrespective if we go to 5.5%, we sit at like the 487 or something we're at this morning. Effectively, it's a yield that outstrips inflation, right? So you have positive real yields out there. And so for investors that have been looking for yield in the marketplace, you have none other than the high quality asset of the US Treasury market that generates a positive real yield that is one above inflation. And so investors have been looking for this for many years. And so you can put this together with a bit of a credit portfolio. It's pretty easy to put high quality portfolios together that yield like 7%. So even if interest rates push up another 0.5% or so, you still have a yield that will offset any price movements there. So from an investment standpoint, bonds are looking extremely attractive today. And if you're a risk taker, you can just delve down in credit. You can go lower credit quality and get 9 and 10% today. That sounds like an equity-like return for a calendar year. And so I think what's going to happen as we get later into the year, people are going to reassess this as they position portfolios for 2024. And they're going to really look at what's going on in the market and see that there's a much more stable return profile in the bond market. And all this carnage we've seen has just set up a really good opportunity for the next couple of years in the fixed income markets.
Well, you've certainly got me thinking. All right. Our thanks to Jeffrey Sherman, DoubleLine Deputy Chief Investment Officer. And we'll be talking to DoubleLine Capital's founder, Jeffrey Gundlach, at Yahoo Finance Invest. You're going to stay tuned for that. Meantime, Intel shares are jumping this morning after the company pledged that despite seeing its 7th consecutive quarter of sales declines, its cost-cutting efforts will result in growth to come for the current quarter.
Remain on track to reducing costs by $3 billion in 2023, and we continue to see significant incremental opportunities for operational improvement as we execute on our internal foundry model.
And the chipmaker also gave a better than expected sales forecast as it battles with waning PC demand. Yahoo Finance's Dan Howley is here with more. Dan?
Right, Diane. The big news here for Intel obviously is a beat on the top and bottom line, but there's a little more to dig into. So let's just go over the base numbers. Revenue for the quarter came in at $14.2 billion versus expectations of $13.5 billion. EPS came in at 41 cents, adjusted EPS, versus expectations of 31 cents. Part of that has to do with the client computing group. That's basically the PC chips that they sell to other vendors. That came out at $7.9 billion versus expectations of $7.4 billion. So seeing a uptick there, continued uptick as far as overall revenue goes for that group, and that leads into the recovery for PCs that we're beginning to see. PC sales should start to really pick up now after really difficult comps from last year. And if you listen to Gartner, for instance, they'll tell you that they're seeing improvement as far as overall PC sales go into 2024. One of the things that's worth pointing out, though, is while they did beat on the client computing side, the AI data center side missed. That revenue came at $3.8 billion versus expectations of $3.9 billion. And you would expect that, with the AI hype and craze going on, that would really have caused the stock to get hammered, but not so. Intel basically continuing to turn itself around and returning to profitability after a big miss a few quarters back. I think seeing the results that came in, investors were more than happy to get that. And one other thing I want to point out is during the call, Pat Gelsinger basically, obviously went over the entire roadmap that they can for now as far as what they're doing with Foundry, with chips. But he also was asked about potential competition from NVIDIA and Qualcomm building their own CPUs. Now, NVIDIA does make CPUs. Obviously, they're known for GPUs, graphical processing units, but they also are making their own CPUs in servers. Those are only for servers right now. CPU is basically, if you don't know, the brain of any computer. And you need them to work alongside GPUs to have anything really work well for you if you're doing AI. On the PC side of things, though, Intel is reportedly working on its own CPU based on ARM technology. Qualcomm just unveiled its own CPU. And so Gelsinger was asked about the potential competition, and he basically poo-pooed that, kind of cast it aside. He said, in the past, ARM and Windows alternatives have been relegated to pretty insignificant roles in the PC business. He said that while they take all competition seriously, they're going to let history be their guide here, and they don't see these potentially being all that significant overall. So kind of just, slam dunking on the upstarts, even though those same upstarts are dominant in their own respective fields, Qualcomm in mobile and NVIDIA in GPUs.
All right, Dan Halley, thanks so much for breaking that down. And everyone's going to want to stay tuned for our 3 to 5 p.m. show today, because our executive editor, Brian Sazi, will be speaking with Intel CEO Pat Gelsinger about those results. You won't want to miss that. Again, that is at 3 p.m. Eastern Time today on Yahoo Finance. Just about 4 minutes here until the opening bell. Let's see some of the action that we're seeing in the pre-market on the heels of that inflation print, Jared.
Yes, it looks like stocks are liking it a bit. We can see the Nasdaq is in the lead, up 0.8%. Let's just take a look at the 4-day price action. Not too much of a move today off of that inflation report. I've noticed that the market tends to move off CPI, which is released 2 weeks earlier, more. But nevertheless, it's been a rough week for stocks, and especially the Nasdaq. One other thing interesting yesterday was the Russell 2000 was in the green, while the other indices were in the red, specifically the Nasdaq and the S&P 500. Last time that happened, July 2020, that was in the midst of the pandemic, after those lows were in, and then you'd have to go back to 2008. So something underfoot here. And let me just show you the price action in the sectors that we've seen so far this week to illustrate how defensive things have gotten. If you look at what's green here, utilities in the forefront, that's up 3%, followed by real estate and staples. Those are all defensive sectors. So the fact that they're green is not actually good. And then you look at the bottom line, XLC, that is communication services. That's what we see. That's what houses Alphabet as well as Meta. We've seen what happened to them this week. And then energy. Energy has typically been a bastion this year. When mega caps have not been surging, it's been energy. Now, this week, they are both selling off. So I think we should take note of that. And then to round out the bottom, we have consumer discretionary. That's retail, tech, and healthcare. Healthcare is also somewhat defensive. Let's take a look at the Nasdaq here. And we can see this is over the last 4 days. But I'm going to throw on the pre-market quotes here. And you're going to see these little boxes. We do see some green showing up. Amazon up 5.5% after that report we've been talking about. Finally, want to close with a note on seasonality from Ryan Dietrich. He's pointing out that the AAII Bears Index, and that's a sentiment index, is the highest since early May. That means there are a lot of bears coming out that's actually contrarian, not overly surprising given the weakness. Be aware it is late October, historically when things tend to turn around. And he pulls up a seasonality chart that indeed shows we are right at the potential bottom versus the way he has sliced and diced the market. However, I would say seasonality has taken a back seat to rates. We've seen them screaming higher. If the 10-year screams north of 5%, you can forget about any equities market turnaround. If it doesn't, if it rolls over, well, that's supportive of equities. I think it's as simple as that, guys.
Yeah, well, we'll be watching what yields do, see if what the trend is and how to play that. All right, Jared, stay with us for the opening bell. We've got more of your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Opening bell on Wall Street just moments ago. Let's do a quick check of the markets here. Investors digesting the latest print that we got on inflation. Also, a couple of key earnings reports out before the bell this morning. We're still looking at a mixed picture for the major averages. You're looking at the Dow off just below the flat line, off just about 0.1%. Jared Blakely is still standing by with some of the movement that we're seeing here at the open, Jared.
Well, I was just telling you how unfriendly the environment has been this week for the mega caps, but today they are the leading sectors. XLY, that's consumer discretionary. Biggest component is Amazon. I'm going to chart that in a second, but not surprisingly, that is in the lead after Amazon earnings. That's followed by tech, that's XLK. Those are the two outperformers, and then communication services and materials close on the heels of the S&P 500 overall. And here's that Nasdaq 100 look. Wow, what a different picture than the entire week, which is what we're seeing right here, a lot more red there. But you'll notice Amazon and Microsoft still holding on to gains. They both had favorable earnings reactions in the stock market this week. And just a quick check on Amazon stock, we can see, yeah, it had fallen down by quite a bit, but bouncing back quite nicely. You might call this a little bit of a bull flag there. But let's take a look at some of the leaders, and we can see China, KWEB, that is a Chinese internet ETF, that's in the forefront, up 2%, followed by U.S. internet stocks, that's FDN. Chip stocks, IPOs, ARC. I want to go to semiconductors just to see what Intel and its cohorts are doing. Intel is up 8.4%. Here's the year-to-date look, and you can see a very gently sloping upward trend channel just bounced off the bottom of that, so pretty healthy right there looking for Intel. NVIDIA also up, but Taiwan Semi down about 1/3%. Let's take a quick look at China to see where some of that green action is. Here we see Pinduoduo up 3.6%, Alibaba up 1.5%. So we'll see what gets started this month. But here's a look at the month to date, and you can see much more of a mixed picture for China, guys.
All right, Jared, thanks so much for breaking that down. Of course, we're going to continue to track today's action here at the open. But let's talk about some of the individual movers or individual stocks that's catching investors' attention. We got to start off with JP Morgan. You're looking at losses of just over 1% for shares this morning. The big headline out, CEO Jamie Dimon is set to sell 1 million of his shares starting in the new year. Now, this is according to a SEC filing. They're doing it for diversification and also for tax planning purposes. Now, Dimon holds on 8.6 million shares of the bank, so selling 1 million. The significance of this, though, is it's the first stock sale that we've seen from Dimon during his tenure at the company. Yeah. And Diane, we know that he's been there for almost 20 years, since 2006. We talk about the fact that he has been there throughout the financial crisis. We know that he's a big believer in his company, is why he holds such a significant stake in JP Morgan and also the previous banks that he has led in the past. So significance of this, I think investors are asking about what this signals just in terms of any weakness maybe inside JP Morgan, or maybe what it means for his plan going forward. But they did reiterate in this SEC filing that Dimon continues to believe the company's prospects are very strong.
Yeah, to me, this brings up the question of just succession planning, because you think about earlier this week, we heard news from Morgan Stanley. That was a prior CEO who had been there a long time, similar to Jamie Dimon, when you know his story, how he came from Citi, then to Bank One, to ultimately leading the nation's biggest bank, right? And, you know, to your point, you said the family holds more than 8.5 million shares. So to be fair, this is a little over, less than 15% of the shares that they hold, right? So it's not a huge deal in terms of a percentage basis. Yes, the number sounds big, and then just to go back to the confidence question, because we think back to the financial crisis, as you mentioned, Dimon bought 500,000 shares in 2009. So that showing confidence. Now, we don't know if this is a confidence question. He says it's not, clearly. But you do wonder, it begs the question about what his plans are for the future in terms of his role at JP Morgan Chase. Who is being groomed for that spot? Who will take over from him, who's been such a strong leader and created such a huge bank and an institution in JP Morgan Chase? Yeah,
we know there has been some talk of potential successors of who could potentially succeed Jamie Dimon, Marion Lake being one of those, as CEO of the consumer lending division right now. there is lots of talk just about what JP Morgan could potentially look like after Diamond, but I don't think you can read maybe too much into this, at least for now, given the fact that this release did, of course, reiterate the fact that Diamond has tremendous confidence in the bank at this point.
Indeed, indeed. Another company we're watching, Ford. It released its third quarter results on Thursday after the bell, missing expectations. Now, this comes just after the UAW and the automaker reached a tentative agreement that will be voted on by union members this coming Sunday. We want to bring in Yahoo Finance's Pras Subramanian, who has been following all of this closely. Pras, take us through the latest.
Hey, Diane. Yeah, so a highly anticipated report last night following the big news of that UAW tentative deal. And then they reported mixed results shortly after that. But a few things stood out to me with the report and also the ensuing conference call. So the first thing was Ford said that it was on pace to hit its improved outlook before the strike. But as you know, it pulled guidance last night, similar to GM, due to uncertainty here. Ford said it lost $100 million in Q3 and $1.2 billion in Q4 due to the strike. But it said that its costs are still unknown as it restarts production. So I was a little surprised to hear we didn't get an updated figure yet. Well, they said they will issue one shortly. Number two, Ford is pushing back its EV investments, saying last night it's going to push out around $12 billion in those EV investments until capacity is needed. It means they're going to pause some plants that were scheduled to be built in the next couple of years. Ford said in a statement that many North American customers interested in buying EVs are unwilling to pay premiums for them over gas or hybrid cars, thus sort of compressing profitability and prices. So it's a challenging environment over price with EVs. And now they're saying that they still want to keep investing in EVs, but they want to sort of focus on their next gen cars because their current cars aren't necessarily competitive on cost and features, basically saying that Ford is not competitive right now compared to Tesla. And finally, it's unclear in what they said with the tentative deal that if battery plants are part of the UAW agreement. Ford CFO John Lawler on a media call declined to say if unionization at battery plants was part of the deal. Now, Ford, of course, isn't at liberty to talk about these things because of the fact that they still need to be discussed. The UAW is still discussing these things with their membership before they can vote on it, like you mentioned. But this is a big reason why the UAW didn't strike additional GM plants a few weeks ago, because it said that GM agreed to include battery plants as part of the master agreement, as they call it. So it's unclear if Ford has this sort of provision in the UAW contract that it agreed to, but I can't imagine it doesn't after the UAW made such a big deal about those battery plants included into the master agreement.
Pras, I'm curious we've gotten a slew of news within your sector this week when it comes to UAW strike, what we heard earlier this week from GM, even yesterday with Mercedes-Benz, obviously talking a lot about the EV pressure there, and then also what we heard last night from Ford. I guess, how does that then change the landscape when we talk about whether or not some of these more traditional automakers are able to compete with Tesla at this point, given the fact, and really on the heels of the comments from Jim Farley last night, talking about the fact that cost is obviously the most important thing right now, and they don't have, I guess, the competitive advantage that Tesla does at this point?
I think what's happening here is these traditional legacy automakers, as we call them, assumed that EV demand would be pretty strong even at this point of the cycle of where we are economically, and that they could charge higher prices to sort of defray some of those investments that they need to make now as they try to catch up to Tesla. And what they're discovering is that the demand is just not there because the price is so high. I think, taking a step back, we are seeing that EV sales in this country are past an inflection point. They have been rising quarter after quarter after quarter. They're just not supercharged just quite yet. And I think a big problem of that is, of course, pricing, but also we mentioned the charging infrastructure, the lack of that, those chargers in the country is a problem for people. So they're kind of concerned about, well, I should invest in an EV when I don't know if I can charge on the road. So I think it's like a dual sort of problem that the legacy OEMs are facing, whereas Tesla, of course, they're right now enjoying those benefits of scale. They can make cars cheaply, EVs cheaply, they can sell them. The question now is how willing are they going to go to sort of cutting prices to give this consumer what they want? We know that people are paying a sort of higher price for Tesla shares because they think that the margins will remain high. That remains to be seen. But I think there's definitely an inflection point here. We're not changing our course in terms of where the country's going from an EV point of view. The question is, how long is it going to take to get there? And now it seems that it's going to take a much longer sort of time frame before the country is majority EV.
Yeah, Jim Farley saying great product is not enough in the EV business anymore. We have to be totally competitive on cost. So really sums up just where the auto industry is in this transition. Pras Subramanian, great stuff. Thanks.
Thanks.
Let's take a look at one of the other tickers this morning that we are closely watching, and that's Deckers. Now, the maker of UGG boots and also Hoka sneakers is trading to the upside. Look at that, gains of nearly 14%. The company moving on its earnings results, sprinting past expectations, revenue spiking 25%. Their DTC, direct-to-consumer sales, jumping almost 29%. Deckers Outdoor also raising its fiscal year sales forecast to about $4 billion, with its CEO saying, quote, the strength of demand for our Hoka and UGG brands continue to drive exceptional performance during the quarter. And taking a look at some of these sales figures here, Diane, just in terms of where Hoka and where UGG stands right now, it's huge. UGG net sales are up 28% on a year-over-year basis, $610.5 million. You have Hoka net sales up 27%. Yeah. We talk a lot about the growth trajectory of these brands, the fact that it seems to remain at least resilient for now. Consumers willing to pay some of these higher prices for these products. Obviously, Deckers in a position to really benefit from that trend.
Indeed. It's so funny. I remember once upon a time where you would occasionally see a pair of Hoka sneakers. Now they're everywhere. They're pretty ubiquitous at the moment. I mean, on my way here from our office, I saw someone, and that's just not uncommon now. And when you think about how Hoka is compared to, say, Nike in terms of running shoes, I know we've talked about this, and even making a bet on the shares of Nike year to date, down 15%. When you look at Deckers year to date, that stock is just surging more than 40%. So if you started out the beginning of this year making a bet on the company that is behind Hoka, that's behind UGG, you're winning. If you made that bet on Nike thinking that they were going to continue to run this lane, you bet wrong.
Yeah, and when you take a look at the analyst commentary coming out on this, Piper Sandler saying that the growth at UGG was the highlight of the quarter. Deckers raising its growth expectations on the brand to mid-single digit from low single digit. Also just viewing that she even believes that this is still conservative when you take into account the factors that are at play, the fact that we do see lower freight costs, favorable product mix at UGG, and also the higher mix, the DTC sales, setting up the company for success here in this very important holiday quarter.
Exactly.
And then, of course, going ahead to 2024.
That's what I was going to say. It may be on somebody's Christmas wish list. So I think it bodes well for them this holiday quarter. Yeah. All right, we'll leave it there. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Higher prices did not stop consumers from grabbing their Chipotle burritos last quarter. The food chain beat the street's estimates in the third quarter. Also saw same-store sales growth of 5%. Chipotle CFO Jack Hartung joins us now alongside Yahoo Finance executive editor Brian Sazzi. Jack, it's great to see you here. So certainly we're seeing some encouragement here in terms of the street's reaction to these results and move to the upside here in shares today. But what struck me in this report is that Chipotle once again remaining strong, remaining resilient in the face of higher prices, in the face of the fact that so many of your competitors are seeing consumers pull back their spending. What do you attribute this strength to?
Yeah, listen, I think a lot of it is that we are priced lower than other competitors. You know, even though we've had to battle inflation like every restaurant company, when you look at the cost of having a meal at Chipotle compared to others in the fast casual, our prices are anywhere from 10% to 25 or 30% lower. So if you're looking for a quality meal with real cooking and customization and convenience that Chipotle offers, you can't get it at a better price than at Chipotle. And we think that in these times where people are under pressure and they're a little bit fatigued from inflation, Chipotle is a great alternative.
Jack, Brian here, always good to see you. You've been at Chipotle for a while. You've seen really everything almost since day one. Social media loves talking about Chipotle, as you know. What do you say to those folks that suggest Chipotle has lost a step, that it's not the same Chipotle as 5 years ago?
Yeah, listen, I guess there's going to be Chipotle haters out there, but we feel like the food is better than it's ever been. We feel like the convenience because of digital, digital 5 years ago was 15, 16% of our business. Now it's almost 40% of our business. We feel like the people in our restaurants are better than they've ever been. Our stability in the restaurants in terms of holding on to our people is the best it's ever been. And then we have better menu innovation. 5 years ago, we didn't really have menu innovation. So now we've got carne asada, which customers are responding in a big way. A couple months ago, we had chicken al pastor, which our customers love. So are we a different Chipotle? We certainly are, but I think we're better.
Jack, okay, so I am a fan of Chipotle. I like your burrito bowls, your salad bowls. I don't do the burritos currently, just because I'm watching my waistline. But I got to ask you more. I got to dig deeper into the pricing. When you talk about it being, you can't get a better price elsewhere, I do feel like the prices have skyrocketed over the years. What are you watching for in terms of the consumer's elasticity when it comes to your pricing? Where do you say, okay, we can't take it further than this?
Yeah, first of all, the prices that you put up, I think are probably in New York. So that's not what most customers are paying. The average chicken burrito is right around $9 if you go into a restaurant. Now it's more for delivery because we've got to pay for the delivery fee. But go into our restaurant and order in the app and then pick it up. The average Chipotle burrito is right around $9. In fact, more than half of our restaurants, the average Chipotle burrito is under $9. You go anywhere else and get a chicken sandwich or a chicken bowl or a chicken, a salad with chicken, you're going to pay $11, $12, $13. And I'm talking about across the country. So when we compare our prices to others, that's where we're at least 10, if not 20 or 30% below. We also look at either our internal value scores, and then outside of Chipotle, independent studies have done it as well. They ask what is the best value out there, and they will, stack rank us against other companies. We always end up on top. So our customers say it, and when we look at the data, our prices versus others, which you have to do on a market by market basis. You can't compare a New York price to something in the middle of Ohio, but when you compare within market, we're always the better alternative.
Yeah, Jack, when it comes to pricing, I'm curious just to know a little bit more about that strategy because you have been forced to raise prices 4 times in the last 2 years. A lot of that obviously because of inflation, higher input costs that you at Chipotle are facing. How do you see that pricing strategy shaping up going forward?
Yeah, so we just issued or rolled out a 3% price increase because our current food and labor inflation is running about 3 to 4%. Our strategy has always been just to keep up or maybe stay a little bit behind inflation. We don't want to build our business or grow margins based on inflation. We want to grow our business and grow our margins based on transaction growth. And you saw in the quarter, we had strong transaction growth in the quarter. We expect continued strong transaction growth in the fourth quarter. And before this price increase, we didn't raise prices until over a year ago. So we've been over the years, and especially in the last year or so, we're usually slow to raise prices. And you're right, we've had to battle inflation. But if you look at the inflation we've taken on over the last 2 years and the pricing, we've not even fully priced in that inflation.
Jack, and next year, 50% of your restaurants are in California, and they're going to be dealing with higher wages to what, $20 an hour? How much of a headwind is that for Chipotle? And then, as the CFO, do you pull back on how many stores you are going to open in California over the next few years?
Yeah, first of all, Brian, that is a significant increase. We tend to pay higher wages than others. Our average wage in California is about $17. To get up to 20 as the minimum. Keep in mind, when the average is 17, you've got some below, some above that. To get the minimum to 20, we're going to have to raise wages across the board by somewhere between 17, 18% up to 20%. Significant increase. Our plan is we have no choice. Every restaurant company in California is going to have to do this. We're going to have to raise prices. We've said that. We've not made a decision. We'll wait till we get closer to the April timeframe. But we'll have to raise prices somewhere in that mid to high single digit range. In terms of opening restaurants, we'll still open restaurants. We have more restaurants in California than any other state. We do really, really well in California. And everyone's going to have to raise prices. So I would expect, Brian, when all this is said and done and things settle, that Chipotle will still be 10 to 30% below other competitors in California.
And Jack, really quickly, have you noticed any impact in terms of the weight loss drugs and people cutting down on the size of their order?
No impact at all. And we think we will fare well. We're watching it very closely. At Chipotle, you can get exactly what you want. And so over the years, as people have pursued different diets, you can come in Chipotle. It's like going to a grocery store. You can pick any ingredient and you can custom build your burrito or your bowl to exactly your taste and your diet. And so we think whatever happens with this weight loss drug, I think the customers are going to be able to come to Chipotle and get exactly what they want.
My order's double protein all day, Jack. You know that. You know that.
Love it. I love it. I got to have a meal with you and see that. I got to see it.
Yeah, let's do it. Let's go.
I'm in.
All of us, we're all going to Chipotle in Ohio, where I'm from. All right, our thanks to Chipotle CFO Jack Hartung. Thank you. Alongside Yahoo Finance's executive editor, Brian Sozzi. Thanks to both of you. All right, we've got all your markets action ahead, live from the Nasdaq market site. Stay tuned. You are watching Yahoo Finance. We're live from the Nasdaq market site. Now, earlier today, U.S. fighter jets carried out airstrikes against Iran-linked facilities in Syria. The move was a retaliation for a slew of missile and drone attacks against U.S. personnel in the region. Defense Secretary Lloyd Austin saying the strikes are, quote, separate and distinct from the ongoing conflict between Israel and Hamas, but signal escalating tension in the Middle East. Joining us now with more is Yahoo Finance's own Rick Newman. Rick?
Hey guys, well, this is not a huge escalation, the type that people worry about when they talk about a wider Middle Eastern war, but it is definitely a small escalation. There are about 2,500 American troops on what you might call permanent station over in the Middle East. They're doing counterterrorism operations and other things like that. And these forces, these militias affiliated and backed with Iran and backed by Iran, have been dropping bombs on some of the bases where the forces are based, particularly an airfield in Iraq and I think another one in Syria. So U.S. fired back. They say they attacked some weapons and ammunition facilities in eastern Syria, and they're trying to send the message, hey, knock it off. Stop trying to harass American troops. So we will see where this goes. I mean, this sort of thing has happened before, but I guess Iran decided, let's just see if we can swat the Americans a little bit and provoke them. So this just adds to the tensions about how much worse this whole situation could become in the Middle East.
And Rick, when we talk about what that escalation could look like, this comes amid the fact that we have a new speaker in the House. We know that there's a number of policy deadlines here on the table, just about a month to go until that government funding deadline. But of course, one of the key issues that Congress is debating right now is funding to Ukraine and funding also to Israel. How do you see the new speaker, I guess, going about or approaching this, given the fact that he has had some words of criticism for the Biden administration?
Well, he actually is on record as a member who voted as opposing any additional aid to Ukraine. But he seems to be changing his story a little bit. And I think it's an example, when you're, sort of in the back of the pack and nobody really notices your vote and the legislation is going to pass anyway. Some members of Congress just they vote in a certain way just as posturing for whatever they think their constituents back home want. So now he's in a leadership position. Mike Johnson has indicated, well, maybe he is open to more funding for Ukraine after all. But what he wants to do is separate aid for Israel and aid for Ukraine. Biden wants to put that all in one big bill, basically so he can get the maximum amount for all of his priorities under the guise, if you will, of it's all emergency spending. So Biden's asking for $106 billion all told. Most of that is for Ukraine. I think about $14 billion is for Israel, and there's some other stuff in there. I would not be surprised if that gets whittled down. The big question is how much is Ukraine going to get? I think Israel is going to get a good chunk of money. The question is how much will Ukraine get? And this is going to actually test Mike Johnson's leadership skills, because in the Senate, which Democrats control, there is basically bipartisan agreement. Let's give Ukraine whatever it needs. Many Republicans feel that way, as do most of the Democrats. There are a lot of Democrats in the House and many Republicans who also feel the same way. So we will see how Mike Johnson manages to negotiate with these very seasoned politicians in the Senate and also in the White House.
All right, Rick Newman, as always, thanks so much for breaking down the latest coming out of D.C. Have a good weekend, Rick.
Bye, guys.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. I'm Shauna Smith alongside Diane Kinghall at the Nasdaq market site here in New York City. We're just about 30 minutes into the trading day. Let's take a look at how things are shaping up. When you take a look at the broader market, stocks are higher. After a big week of earnings, we have Amazon and Intel leaving investors with a prettier picture for big tech than some of the other giants that reported earlier this week. Plus, the Fed's preferred inflation gauge, PCE, grew in line with expectations, a positive sign ahead of the Fed's next meeting. Taking a look at some of the individual movers this morning, Charter Communications shares are falling. We're looking at losses of just about 5%, despite beating the street's expectations in its third quarter results. Now, the Spectrum owner was hit hard in its video division, revenue falling 8.6% from a year ago due to a, quote, higher mix of lower-priced video packages within Charter's video customer base, as well as $63 million of credits that were offered to customers who temporarily lost access to Disney. Now, that outage came amid the dispute between the two companies. Charter lost about 6% of its total video customers in the quarter. We're also watching AutoNation. It's on the move this morning after its third quarter results show that the company's first year-over-year growth in total unit sales in 8 quarters. The auto retailer reported double-digit year-over-year growth in the new vehicle sales, as well as strong growth in used vehicle volume. Still, though, earnings for the quarter were down about 8% from a year ago. We're looking at losses of just about 0.3%. We're also taking a look at Enphase stock here, extending its losses. Now you're looking at shares off just about 14%. They released third quarter results after the market closed Thursday. The company forecasting fourth quarter sales between $300 million and $350 million. That was well below the street's expectations for $579 million. Enphase is also projecting that the slowdown in solar product sales would last through the first quarter of 2024. Well, new inflation data is showing prices accelerating here to a 4-month high in September. Core PCE index, which excludes the volatile food and energy prices, rising 0.3% on a month-over-month basis, up 3.7% on an annual basis. Here with more on how that's impacting the manufacturing sector, we also want to talk about the latest the UAW strikes, also a new results study out today. We want to bring in Jay Timmons, National Association of Manufacturers CEO. Jay, it's great to have you here in studio. Thanks so much for stopping by.
Great to be here.
Yes.
So let's start with the latest print that we just got on inflation. In terms of what you're hearing from your members, how big of a headwind, how big of a challenge is this persistent higher cost, higher pricing environment for their business right now?
So I think you have to look, Shauna, at all of the cost pressures on manufacturing. Bottom line is we want to make sure that manufacturing can compete with the rest of the world. That means you can't drive up costs, right? So you think about the things that we can control. You think about labor costs, you think about regulatory costs, you think about energy costs, but then inflation is factored in, and that's kind of on top of all that. So we do hear from our members that there is a lot of headwind out there when it comes to the inflationary pressures, but I have to say I think it's easing a little bit. You saw it on that chart, slightly easing, and we feel pretty good that the inflationary pressures are going to be coming down a little bit next year.
So one of the things you talk about is labor costs, and obviously we know a lot of focus has been on the UAW and the strikes there. So with where things stand now, are you concerned about the continued effect to, say, smaller manufacturers?
So that's a perfect question, Diane, because that is exactly where I think the pressure hits. So if you think about that supply chain and all of the downstream effects of a striking company, for instance, or a company that's on strike, you find that these smaller manufacturers are having a really hard time making the choice about, frankly, keeping their doors open or laying people off for a certain amount of time. And if they lay those folks off, are they going to go somewhere else? And then they're not going to be able to bring them back. We do have a labor shortage in manufacturing, 600,000 open jobs. So anything that really upsets that delicate balance, it's a threat to manufacturing.
Do you think the view is still that workers have the upper hand, given the fact that we have seen a rising number of strikes across the country, given the fact that we have seen this union movement? Is the power still mostly in the hands of employees?
Look, I don't know that if I want to handicap who has the power balance. What I would say is that when you have a strong relationship between management and workers, that's when you're the most productive. Culture really matters, right? How you operate your facility, how you treat your employees, and good management worker relations is really what manufacturers try to strive for. Sometimes you see and we have unionized and non-unionized shops.
Yeah.
Sometimes you see large labor leaders who are not as in tune to or don't really care about the relationship that perhaps has grown over time. I don't want to opine if that's what's happened here or not. I can say, though, that it's never good when there's strife between the workers and management.
So deal makers say the best negotiations and the best deals are when both sides win. Can both sides win when you think about UAW and the automakers for GM, Stellantis?
So as long as labor leaders are looking at the pressures that exist for corporations today, I think both sides can win. Again, every deal is going to be different. One of the ways that they need to be looking at the issues coming at manufacturers is, again, those cost pressures. We've just released a study about the regulatory burden on manufacturers that is showing that today it's $3 trillion worth of regulations on the entire business community. About $350 billion of that is on manufacturers alone. That's about the $3 trillion is about 12% of our GDP. And that's bigger than, the $350 billion, I should say, is bigger than the GDP of 29 states. So those pressures are really adding up. And by the way, that translates to $29,000 per employee per year for a manufacturer, or $50,000 per year per employee for a small manufacturer. And you think about all the regulations that are coming down the pike that are not even included in that figure, those numbers are adding up, and they're adding up quickly.
Well, Jay, when you talk about the problems that are coming, challenges that are coming from these regulations that have been put in place, I guess can you identify which ones are most problematic? And when you look ahead to 2024, you mentioned more regulations obviously coming down the pike. How much more of a jump you see that potentially getting when it comes to the cost per employee?
That jump is going to be significant because of the things that are coming down, as well as the fact that many of those regulations are conflicting with each other or taking products offline like ethylene oxide, which sterilizes our hospitals, and we won't have anything to do that with if that regulation takes effect. But I think back to the Obama administration's particulate matter 2.5 regulations. And those at the time cost $350 billion for manufacturers. Well, today we're talking about lowering that number even more, and it could put 40% of our country in a non-attainment area, which means no manufacturing investment, no job growth, which of course means no wage growth for manufacturers. That's counterintuitive to the president's agenda to grow manufacturing in this country. I mean, you think about chips and science and infrastructure investment and the policy provisions of the IRA. That was all geared toward growing manufacturing in the United States, and unfortunately, the president's agencies are not listening to what he's trying to achieve.
All right, Jay, we'll have to leave it there for now. Our thanks to Jay Timmons, National Association of Manufacturers CEO. We've got all your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear this
Silicon Valley
week.
Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates.
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
The Nasdaq composite slipped into correction territory this week as small cap stocks gave back all their gains since the Biden election, prompting bearish headlines and warnings from pundits. Could this lead to an uptick in short-term buying opportunities? Let's toss things over to our very own Jared Blickery and Michelle Schneider, chief strategist at MarketGauge.com. Take it away, guys.
Mish, really great to have you here in studio. Let's talk about the S&P 500 first, then we'll get into some of the small caps and tech stocks. But first, here's a year-to-date look at what's happening. 4,200 in the index. If you're looking at SPY, it's 420. We can see we broke that very recently. What are you seeing in the technicals here? Anything to be concerned about?
Well, what's so interesting coming into today was that the McClellan oscillator, or the market breadth, actually stopped declining while the price continued to, which generally means that the selling may be at this point in time drying up. So that 420 or 4,200 level is important, but you can see if you go back to May and June, we're coming into some support levels, which probably means a bounce. The question is how far? That 417 to 420 level will be the key resistance. It's also, interestingly, a 23-month moving average, which means that whole expansion we saw over that 2-year business cycle, the first half of this year, has now been violated. And so most likely it points to a stagnation rather than maybe the end of the whole market.
All right, so maybe a bounce is in the cards, but I'm telling you, if I look at the Russell 2000, this has simply fallen out of bed, as you heard Diane say, lowest level since basically the Biden election. What are you seeing in the small cap space right now?
Well, yeah, I mean, this is completely contrast to what we just mentioned in the SPY. That doesn't mean it couldn't have a bounce. But looking back, again, zooming out at that monthly situation, I love those monthly charts. This broke down under the 23-month long before the SPY did, number one. Number two is it broke the 80-month. That's a 6 to 7 year business cycle. Typically, that would be a recessionary indicator because it means a real turn down in terms of the business cycle. So, yet it's a monthly, so that means we have some chance maybe of getting back over 170 if we're looking at IWM, but right now that seems like a Herculean task. And if this can't make it, then I would not necessarily stay very positive in anything.
All right, looks like transportation kind of in a similar vein here. I want to skip ahead though to NVIDIA actually. We were just talking about this over the break, and we have this this island here, if you want to call it that. It's basically a 3 or 4 month consolidation, but we're at the lower end of this. And if you look real closely and squint, you can see kind of a head and shoulders top as well.
Well, yeah, NVIDIA, of course, would be obviously something that everybody's going to have eyes on to represent the chip industry. And of course, we have some fundamental reasons to be a little bit concerned with China. But just from a technical standpoint, there's also that big gap that you saw on the original chart.
Here we go, right there.
So this is another scary situation in that you're right, head and shoulders top could emerge. And if we start to fill into that gap territory, I do not look at that as a healthy sign. It seems to me that the whole semiconductor growth stock space got a little rich, especially when we just looked at transportation.
A little bit too much hype?
Yeah, too much hype. So yeah, I wouldn't be surprised to see a bigger correction there.
All right, got to hit commodities as well. This is a commodity ETF, tracks the entire space. I'm just wondering, what do you see in here? What do you think about commodities in general?
Well, I have been very bullish for quite some time in commodities. Some of them have been very cooperative in that bullish sentiment, and others have not so much. But DBC really represents the oil and the precious metals, and that's an important area to be looking at right now because of what we're seeing geopolitically. And so with oil as the component of DBC, or if we just wanted to look at DBC, I like around 24.50 to hold. It gets through 25. I think it could scream higher. Oil has to hold $80 a barrel, gets back through 90. I think 110, 130 is realistic. And that's kind of, we're stuck in the range right now.
Yeah, and also want to hit gold because that has shot up recently, quite literally. What do you think of this space? Because if I go out, kind of zoom out to a 5-year view, we're in a very, very sideways consolidation period, but at least at the top of it. Do you see a breakout?
Well, I started out this year thinking that gold could go to $3,000 an ounce. And so I still think that that's very possible, especially given everything that's going on, especially the fact that gold has held up in the face of a stable dollar and higher rates. So there you go. I mean, you're looking at this chart right here. We got through 2000 briefly. We've come down to around 1980. I think this is 2000 to 2050 is really the breakout point. And then what we've seen in gold, and I think this is really important, is that it's been a buy when it looks terrible and it's been a sell when it looks amazing, which means if it continues to go up and buyers come in at the top, then you know it's going parabolic.
A true contrarian trade. Got to hit the other gold. A lot of people are going to take issue with that. Don't write letters. But here's Bitcoin. As I was saying earlier, looks like we finally got that God candle right here. What do you think of the technicals in Bitcoin?
Well, it's spectacular. I mean, again, very commodity-like in that it just behaves beautifully technically. I mean, it took out 28, took out 30, stopping right into some resistance now as we get closer to 35. It looks to me that as long as we hold up over this 30,000 level, 45 to 60,000 is on the table. More importantly, it's now showing, regardless of all of the hype about it, it is showing a separation between what's going on in equities and what's going on in the cryptos. So store of value, mass adoption, you can name reasons, but the charts are good.
Yeah, I focus on the technical. I don't really need a reason here. All right, Coinbase, this is a stock that really got obliterated last year after topping out, I believe, with Bitcoin itself. What do you think of Coinbase? Time to maybe punt a little bit in the stock space?
Well, the range was 70 to 80 for a while. And then last week when the news got out about an ETF for spot,
Bitcoin, sure.
This thing went to 90, like really fast, and now came all the way back down closer to the 70 level. So it's the new widowmaker in my mind.
Move
More
over
so.
natural gas.
Yeah, oh yeah, natural gas actually behaving. It's just consolidating, getting ready to explode. So I think that Coinbase will benefit, is waiting for more news. Obviously, it's a little bit of a departure from what's happening with the actual Bitcoin itself. But again, this can get through. I like these lines you drew here. We can get through all of this resistance. I think 114 is my first target, really.
All right. Well, we have to leave it there. Really appreciate you stopping by. As always, Mish Snyder. Guys.
Thanks so much for breaking that down. Great analysis there on the charts. All right, let's get to our market commentary of the day. And for today, it's a note out from Bank of America saying that they see a probability, or the possibility, I should say, of more trouble ahead when you take a look at the S&P 500. So the strategist there, Michael Hartnett, saying that the index is at risk of dropping another 5% after falling below a key technical level this week. The S&P closed the day Thursday below 4,200, just shy of a technical correction, which would be at or below 4130. Now, this coming as stocks are about to wrap up a third month of declines driven by seasonal trends, as well as the surge that we certainly have seen in yields. Still, though, according to Bank of America's Hartnett, we are looking at tech stocks. They are under high demand, attracting about $2 billion of inflows as giants in the sector reported earnings this week. And I think my takeaway from the action that we've seen this week, and also from this note here from Hartnett, is just the fact that the turnaround story that we were waiting for, whether or not tech stocks, the large, the Magnificent Seven, were going to be able to turn around this market momentum. That doesn't seem to be the case. So then, of course, that brings up what exactly is in store for the markets here going forward. And according to Hartnett, since we did drop below that 4,200 level, the next level we're going to watch is just above 3,900. When you take into account the fact that the Nasdaq is already in correction territory, we're getting conflicting reports out from a lot of these large tech giants. When you take a look at Microsoft, Google, Meta, Amazon, all reporting this week. Google really spooked the street. And we talked to BlackRock's Rick Reeder earlier on in the week, just talking about the fact that he sees this real dispersion, referencing the earnings reports that we got from Alphabet and from Microsoft, saying that we're getting a series of conflicting signs around the markets. And that's why the markets are so jumpy, so uncertain. So when we see any sort of reason to worry, we certainly are seeing that worry then reflected in the broader market.
And again, to your point about that trend line to be watching out for, that 39.41 level when it comes to the S&P 500, and you can see the bulls fighting back in terms of keeping, today, moving away from what we saw yesterday in terms of that level that we were watching yesterday, that closing at 41.37. Now we have some buying action today as investors kind of try to create a floor there, and that 39.41 level considered a key level because it's kind of halted worse in the past. Hartnett pointing out, that there were some exceptions there when you think back to the dot-com bust and of course, the financial crisis where you broke through those levels. So right now, we know that a headwind that everyone has been watching, and Hartnett calls this out too, is yields and what's happening with regard to yields and what that could do in terms of any kind of breakdown in technicals.
Yeah, it's important to point out that we know Hartnett obviously has remained bearish throughout this year, even when we did see the rally in the first half of the year, obviously led by the Magnificent Seven. But I think coming out of this week, and as we look ahead to Apple, just what exactly is in store for the broader equity market between now and the end of the year, given the fact that also obviously another massive headwind is the massive run-up that we've seen in rates.
Yeah, indeed. And can the Magnificent Seven continue to hold up the market? And can they pull in any more inflows? We will certainly be watching that, especially when we see Apple report coming up. We've got more of your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We are live from the Nasdaq market site in New York City. Now, in an era of volatility, the resilient consumer persists. Consumer spending picked up in September, according to the Fed's preferred inflation gauge. Underlying inflation also accelerating, though, to a 4-month high. So what do the next few months have in store for Americans? Yahoo Finance has an exclusive sneak peek at Santander's survey on the headwinds facing middle-income households. Joining us now with more is Tim Winnes, Santander U.S. CEO. So thank you so much for joining us this morning and for this early insight into where middle-income households stand. Why don't you take us through some of the key findings that came out of your research?
Thank you, and it's great to be with you this morning. I think what we saw was that consumers remain resilient and also optimistic. More than 2 in 3 middle-income Americans, and those are people that earn somewhere between $50,000 and $150,000 a year, remain on track with respect to achieving their financial goals and prosperity. And we've got nearly 3 in 4 are optimistic that they'll be able to achieve financial prosperity in the next 10 years. That being said, not surprisingly, inflation remains the largest obstacle. Over 80% of middle-income Americans are concerned and having to make adjustments to spending because of inflation. So I think the key takeaways are consumers resilient, they're optimistic, but inflation remains a watch point.
And Tim, you certainly have a great look at this because I know the majority of your customers are retail or consumer focused. So when you talk about the fact that inflation continuing to weigh on the consumer, what are you seeing just in terms of spending patterns or how this is affecting their investment or spending behavior?
So we're not seeing big changes, and consumer spending came out. So I think on everyday items that continues. But what we did see from our survey is 50% of consumers have put off or delayed large purchases such as a car, and we have more than 40% anticipate that they'd like to buy a vehicle in the next 12 months. And so I think this suggests that we'll see continued strength in terms of used car prices, and that demand will remain resilient over the next couple of quarters.
So, Tim, it's often talked about how strong and resilient the American consumer is. We like our goods, our services, our experiences, et cetera. But talk to us about the impact of the student loan repayments coming back. What did you see in your data?
We've got a third of middle-income Americans have some responsibility for student debt. Either they have it themselves or someone in their household that they feel responsible for has it. And a high percentage of them are concerned about the impact and believe that this will impact their prosperity in the coming 2 quarters. So we do think that will be a drag and be impactful for consumers here starting in October.
Tim, when it comes to confidence within banks specifically, obviously when you look back to March and a lot of the issues that we saw within the regional banks following the collapse of 3 of those banks, are consumers, has that confidence been restored? I guess, how are they feeling just about the strength within the sector at this point?
Yeah, what we've seen here at Santander is that communication is key and key to trust, which is the cornerstone of our industry. And so we've seen that be positive and stable here at Santander. And in our survey confirmed, we had in the mid 90% of people indicated that they have confidence in their financial institution and in the industry. I think that's very positive. And as you can see there on the screen, they have confidence in the safety and stability of their specific bank and that their deposits will be available to them. So I think this suggests that we're beyond the events from March and into a much more normalized environment.
Tim, just as CEO of Santander US, have you at all shifted your strategy or how you're assessing risk following the events that happened within the sector earlier this year?
We're one of the systemically important financial institutions here in the US. And so we've had monitoring controls and processes in place around interest rate risk, liquidity risk, and credit risk. So certainly we've heightened our view of this, but felt like we had the right controls in place to be navigating through the dynamic environment that we've seen over the last 18 months. That was true earlier in the year and remains true today.
And Tim, I want to tie that into the data that you saw in terms of consumers and middle-income households, how they feel about their confidence in banks.
Yeah, so they remain confident. I was pleased to see the mid 90% range here. And one of the other things that I think was important is what we've seen now is about a third of consumers have taken advantage of higher interest rates. So I think there's been a lot to talk about the negative impact of higher interest rates, particularly on borrowers, but also for those with savings and investments, this is a real opportunity. And I'd say we were somewhat surprised that only a third of respondents have done something about that and taken advantage of higher interest rates. More than 8 in 10 middle-income Americans have savings, CD, or some investment product, and only a third have moved. And I think importantly for consumers to be aware and also take action so that they can benefit from this higher rate cycle.
So, Tim, it sounds like, or are you confident then at this point that the U.S. is going to be able to avoid a recession?
I'm not an economist, so I don't know that I want to predict that. We are prepared for higher for longer in terms of rates. And in our business, we are one of the largest auto lenders in the country. We're a full spectrum auto lending from super prime, prime, all the way through non-prime. We have seen the impacts of inflation and higher delinquency rates, but we also see resilience there in terms of consumers. So we don't see any troubling signs that suggest that there's a recession or major challenge in the near horizon.
All right, Tim Wen, it's great to have you here. Thanks so much for sharing your insights. Santander U.S. CEO. Thanks, Tim.
Thank you so much.
Well, a string of home builders reported third quarter results earlier this week, blowing past the street's expectations and also further fueling analyst sentiment to remain upbeat amid rising rates. Yesterday, we spoke with Whirlpool's CEO about the trends that he's seeing within the housing market. Here's what he had to say.
For probably lack of a better analogy, I would call right now the housing market Dr. Jekyll and Mr. Hyde. And the reason why I'm saying this is, you have two sides. The new housing, you all have seen the order intake is solid because there's just a structural demand, strong demand for new housing. The other side is existing home sales, which is a very, very big part of our overall demand. And existing home sales, as you all seen, are now sub 4 million. You have to go back all the way back to 2010. So you have this odd situation where you have a structural undersupply of a market, which drives positive on new home. These are two very kind of opposing trends right now. Over time, in the long term, we stated that repeatedly, we're very bullish on the mid and long-term U.S. housing.
Yahoo Finance's Danny Romero joining us now for more on her biggest takeaways that we've heard so far from third quarter results. Danny.
Shauna, home builders pulled out all the tools from their toolbox in this third quarter. This week, Pulte Group, NVR, Taylor Morrison, Century Communities all reported third quarter earnings. And Wall Street is digesting this week's results. And if we take a look at those home builder stocks, not too upbeat. They're down right now today. But moving forward, there were a couple key themes discussed across the board on all the calls. First, incentives. What were those incentives? Closing cost credits, interest rate locks, buy downs, a really big strategy to help buyers bring them into the market and allow them to have a lower mortgage rate than the market level. Taylor Morrison said on their call that financial incentives outweigh price reductions. That is a really key and important color when how home builders are really looking at the next quarter and how they're thinking about this high interest rate environment. Another key theme that was discussed is home prices. They were modest this quarter. But others like Century Communities, they actually were able to increase their home prices by about 4% this quarter. That's a little bit giving you some context there. Another thing over the last quarter is that home builders have really changed up their strategy. They've implemented a spec home order strategy, which means that they don't really have a buyer in mind. And another strategy that they're using is the build to order strategy, which allows customers to customize their home. And so some builders have really pointed out that that has allowed them to accommodate their buyers across the board. And first-time home buyers are actually more inclined to buying a spec home than a customized home, because at the end of the day, that could cost them a little bit more. Another factor that was really discussed throughout is seasonality. Remember, the third quarter ranges from July, August, September, and the summer months are really, really important to the housing market because a lot of people move during that time ahead of the start of the new year. Shauna.
So, Danny, you talked about obviously the summer months and how crucial those are, and we've just dug through the third quarter. How does this bode for the fourth quarter for this sector?
Looking forward into the fourth quarter, some executives really pointed out that the first few weeks of October have actually been very choppy when it comes to the sales volume. So that could be something that Wall Street is actually factoring in right now. If we take a look at those stocks, they're down right now. But on the positive side, net orders across the board have improved. And also some of them have actually bumped up their full year guidance on how many homes will be delivered to the market. So that could be something to really look on forward. But again, there could be some bumpiness in this fourth quarter given the fact of rising mortgage rates.
All right, Danny Romero, thank you so much. We've got all your markets action ahead live from the Nasdaq market site. Stay tuned. You are watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear this
Silicon Valley
week.
Bank's collapse is the second largest bank failure in the U.S.
Inflation, mortgage rates,
The diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance. Adtalem Global Education beating the street's estimates on both the top and bottom lines. The post-secondary education provider also lifting its expectations for fiscal year 2024. Adtalem forecasting total enrollment trends to improve throughout the year as well. However, though, with Americans resuming their student loan debt payments and we have student loan debt at an all-time high, what's the path ahead for higher education? Here to discuss, we want to bring in Steve Beard. He's Adtalem's Global Education CEO and President. Steve, it's great to see you. So when you take a look at this most recent earnings report, beating the street's expectations on both the top and bottom lines, I know you have 5 institutions, I believe, both online and in-person learning. Talk to us just about the trends that you're seeing of enrollment and how you see that shaping your expansion plans going forward.
Sure. So Adtalem is the country's largest healthcare educator. We go to market through 5 post-secondary institutions. We're the largest producer of nurses, physicians, veterinarians, and clinical mental health professionals in the United States. The pandemic was a real headwind for higher education as a category. We believe many of those headwinds have dissipated. And we're fortunate to be able to participate in areas where the demand for our programs are high and where the demand for our graduates are high. Workforce shortages are critically important challenges for healthcare delivery systems. And to be able to deliver clinicians at scale is a tremendous opportunity for us.
And Steve, where is the demand the highest within the segments that you cover? Is it nursing? Where are you seeing the demand?
It's really all of the above. There's a huge and growing shortage of physicians. The same is true for nurses. We saw a boom in the demand for companion veterinarians during the pandemic. And obviously, there's a mental health crisis that we're all familiar with, and the need for social workers, psychologists, clinical counselors is higher than it's ever been.
Steve, when we talk about the labor shortage, I guess, give us a sense of where that stands more broadly. Obviously, there's a need for healthcare providers across the board, but just how big of a gap are you personally seeing between demand and supply at this point?
It's huge. We estimate there's a current shortage in nursing of about 200,000 nurses, and that's expected to grow. About 60,000 physicians that are undersupplied, about a 15,000 shortage in veterinarians, and obviously the behavioral health needs of the country are growing rapidly. So these are durable gaps in workforce supply, and we're privileged to be able to try to address them as the largest healthcare educator in the country at scale.
Steve, what are you doing to scale to meet that demand that you're talking about? You put out a lot of big numbers there. So what are you doing to grow the business?
Yeah, we are seeking to expand our market-leading position in nursing, in medical education, in behavioral health, and in veterinary medicine. So it's really about taking advantage of that demand, taking advantage of the need that providers have, and getting out in front of students and getting our value proposition in front of them. What's really distinctive about what we do is that we're not a set of institutions that are focused on being highly exclusive. We're really institutions with an access mission. So our goal is to find the overlooked population of students that may have not gotten into other institutions and give them an opportunity to join these attractive and rewarding professions where the workforce gaps are so big.
Steve, given the fact that student debt is at an all-time high, what can you tell us, or can you give us any insight on your pricing strategy and how that strategy looks going forward?
Yeah, so we've been working to optimize price across our program mix. Where we've got pricing power, we've taken pricing up. Where we've been not competitive or overpriced, we've taken price down. But generally speaking, we believe that all of our programs are affordable. And just as importantly, they're programs that train people for jobs that are well-paying, highly attractive, and where the demand is great. As a result, we have some of the lowest cohort default rates in all of higher education because our graduates are employed, they're paid well, and they can service their loans.
All right, Steve Beard, Adtalem Global Education CEO. Thank you so much for joining us this morning.
Thank you.
We have got all of your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
points that she has is just remarkable. And it seems like you can't really replicate it. This is the pop star of our generation.
She's been in our news. She's been in financial news really throughout the summer. So if we take a look at a timeline of when we started seeing Taylor Swift, we know that Eras Tour really kind of started in the spring. So then it trickles into economic data into the summer. She was mentioned in the Fed Beige Book. Moody's called out Taylor Swift. There was a question to Fed Chair Jerome Powell about the Taylor Swift impact. And then Morgan Stanley highlighting at the end of the summer that the end of the Eras Tour is going to mean slower consumption.
I don't think there's ever been a concert film like this ever before. It's definitely a milestone kind of in the history of cinema in terms of excitement around a concert movie.
These are two of America's biggest entertainment brands with an opportunity to cross over. Why not? Why not lean into it? Why not have fun with video, image, and photos of Taylor and Travis Kelce's mom suite? I mean, that's great. So they definitely realize this is a growth opportunity for them in the audience in a way that maybe men 18 to 34 are not.
We did see a fairly substantial rise for the Jets game, and it was one of our top-selling games of the year once the announcement was made that Taylor was going to be there. She brings a fan base of her own outside of the NFL audience.
One of the most important things about Taylor is that she cultivates an incredibly strong relationship, direct relationship with her fans. There are so many reasons for her fans to get really excited about seeing her. And you know, with 150 some shows across the world, you know, we're just starting to see the real impact.
She's cultivated a community, not just fans who like the music, but a group of people who self-identify by their membership in the community, i.e. Swifties. And her personhood becomes a way by which they represent their identity. That's
Well, Taylor Swift is back in the headlines again, this time for building a 10-figure fortune, earning billionaire status, according to a Bloomberg report. We've talked a lot about the Taylor Swift economy this year, from selling out stadiums across North America to hitting the big screen with her Eras Tour documentary. And now she's out with the re-release of her album 1989, Taylor's version. And I did a deep dive into where her billions now comes from. Of course, you've got the value of her catalog, which she's also worked to get her masters back, so that helping. It's $400 million estimated, according to this Bloomberg data. Ticket sales, of course. I mean, she went on a huge tour this summer. There's still some concerts coming up when you talk about where she's going in South America. That's $370 million. When you look at ticket sales, and this is merchandise as well, streaming, of course, Spotify, YouTube, etc. That's upwards above $100 million. Then, of course, she has properties and royalties, so she's just stacking up millions upon millions upon millions to earn billionaire status right now.
Yeah, and I also think maybe even the bigger takeaway, yes, she's a billionaire, but also just the impact that she's had on the broader economy, right? When you talk about the fact that the Eras Tour, she had 53 U.S. concerts this year, added $4.3 billion to the U.S. GDP. That's according to estimates here from Bloomberg Economics. Breaking that down even further here, the final 6 nights of Taylor Swift's Eras Tour in L.A. estimated to bring in the city of Los Angeles $320 million. We know Taylor Swift was also mentioned by the Philly Fed and the Philly Fed index just in terms of the uptick and really the contribution that her tour made to the city during those concerts, which we all knew went viral on TikTok, on social media, because so many fans were just coming to the stadium to simply hear the concert from outside. So we talk about the massive impact that she's had, and she's done a great job, right, of capitalizing on this popularity, especially this year. Yes, she has been tremendously popular now for almost 2 decades. But when you take into account what she has done this year, it certainly is phenomenal. It's impressive. She's re-releasing her album 1989 today, which we know earned a total of 10 Grammy nominations at the time that it was released. So she's capitalizing on the fact that there's so much attention focused on her following this Eras Tour. And then also not to mention the fact what she's done to the movie theater business, right? When you talk about the box office impact that she's had since AMC released the Eras Tour in theaters, so many people who went to her shows going and watching it once again in the theater is just incredible.
And her crossover effect, you know, from pop star to just general star in general. When you think about even getting a mention from the Fed Chair Jay Powell mentioning how, you know, what this phenomenon like her Eras Tour has done for the economy. So, I mean, Taylor Swift is her own economy, basically.
Yeah, Powell did not dismiss that question when he was asked it during a recent press conference. All right, we got to leave it there, but let's do one quick check of the markets here. Just about 90 minutes into the trading day. You're still looking at a mixed picture. You've got the Dow under pressure, off nearly 100 points. S&P and Nasdaq, though, holding on to gains. The Nasdaq up nearly 1%. Some of the excitement that we're seeing in tech, obviously on the heels of the better than expected strong results, maybe a better way to put it, from Amazon last night. A lot of hype around AI. All right, we'll leave it right here on Yahoo Finance. Rochelle Akufo has you for the next hour. Have a great weekend. We'll see you Monday.
All right.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Big tech in the spotlight. Amazon says AI will bring tens of billions to its cloud division, but can they close the gap with the current cloud frontrunner, Microsoft? And where does this all leave Google? Plus, 1 year since Elon Musk's Twitter takeover, reporting from third-party data shows sinking ad revenue and slumping user figures. But CEO Linda Yaccarino insists the future is bright. We shall see. And it was a gangbusters Q3 for the US economy thanks to robust consumer spending. But data out this morning signaling prices are still rising. Will the resilience continue? And especially looking at credit card companies, they're not so sure. So what can we expect from shoppers as the holiday season gets underway? But first, let's give you a quick check of the markets. Looking at a mixed picture here, all three have been reaching for daylight. The Dow now the only one in the red, down about 0.25%, about 80 points. The S&P 500 there, up about 0.2%, just relatively flat. They're about 8 points. Consumer discretionary leading the charge. Energy taking a beating this morning and the worst performer this week sector-wise. And taking a look at the Nasdaq there, seeing it's up about 115 points or about 1% on the day. It's been a mixed week of very busy earnings here, so the Nasdaq and investors really trying to make sense of it. Let's also check in on the Treasury market, see how that economic data affected yields so far this morning. We see the 5-year flat. Similar situation for the 10-year, up about 1/3%, and the longest term 30-year still above that 5% threshold there, and in positive territory, up about 0.7% on the day. Well, Amazon rounding out a jam-packed week of big tech earnings. The company delivering a better than expected operating margin, while CEO Andy Jassy touts AI as the future of the company's financials. But when looking at results from tech giants such as Microsoft and Alphabet, the big picture for tech becomes unclear. Here to help decipher this week of big tech results is Brad Erickson, RBC Capital Markets Internet Analyst. Thank you for joining me this morning. So, a very busy week, obviously, as we saw here. Interesting when Amazon entered the chat, especially when it came to AWS and the cloud conversation here. Talk about the key takeaways then for bears and bulls off of Amazon.
Yeah, thanks for having me. Yes, thank gosh it's Friday. It has been a trying week in big tech earnings. Yeah, I think for Amazon in particular last night, the over under for the stock, and of course the reason it's up today is because Amazon wasn't as bad as feared, and importantly, I think directionally from here, it's likely to get better. It's not likely to get worse. Now, the bulls need to see material reacceleration in the next year. Just to give you a little numbers, we did 12% in Q3. We think it's going to be just a touch faster than that in Q4, and then accelerating more materially, at least to the mid-teens, call it 15, 16% for full year 24. I think if you're a bear, you think we're going to stay in this broader theme in cloud of optimization, which is a fancy way of saying customers finding ways to spend, maybe not increase their spend so much. I think if you're a bear, you kind of think that's going to continue. You probably have a view that Microsoft is gaining share and that Amazon's not going to hit those numbers next year.
And so with that in mind, we're talking tens of billions of dollars there that Jassy is saying with this AI bet. Are you as convinced at this point? Because it's still very early days at this point.
Yeah, no, I mean, I think based on what they've shown to date, I think there's a lot of evidence to support that they're on their way. Certainly from a product perspective, Bedrock is really the key product here. It's a way, think of it as offering a menu of these large language models. No one model is going to be the perfect fit for everybody. And so I think Amazon's taking that open source approach, and they spoke to seeing a lot of good evidence and traction of that strategy at this point. He also made one really interesting comment, we thought, where he said that he implied that Amazon favorably compares to other public companies that have disclosed Gen AI run rates, which of course would be Microsoft primarily, almost implying that they're larger than Microsoft at this point. So we found that point pretty interesting. But no, I think the tens of billions of comments, the tens of billions of revenue comment, that's more of like call it a cumulative 3 to 5 year comment. So we can't really peg to the numbers so easily. But I do think they're making really good progress, and yeah, we're bullish on that opportunity for them going forward.
And we did know that investors were going to be looking for some of this proof of all this generative AI that a lot of companies touted in the last quarter. But looking at Google Alphabet, still under pressure, and that's after an earnings and revenue beat, and advertising gains as well. But the street really focusing on that cloud revenue falling short and what they were hoping to see with the monetization of AI. But do you think the stock is being unfairly punished today?
Sorry, we were talking Alphabet, I'm assuming. Is that right?
Yes, to see if it was unfairly punished, given how well the earnings report was, but the focus on cloud.
Yeah, got it. I would say so. I mean, the advertising business, we do a lot of channel checks in the ad space. We came in tactically constructive on the space where everybody hit numbers or beat numbers really for Q3. Meta's guidance was fine for Q4, even including some impact they called out from the Middle East. Google had an unfortunate quarter with the cloud business, and it sort of brought everything else down. And with the Meta result on Wednesday, I think the takeaway there was, unfortunately, people were looking for kind of any reason to sell the stocks. I think that's probably a reflection on the broader macro where we think the consumer is going, but kind of looking for an excuse to sell the stock almost, and just made it a tough week until today with Amazon, fortunately.
And so speaking of Meta, then obviously 2023, the year of efficiency, seemingly paying off at the moment. Obviously the metaverse play, if we look over the past 5 years, still seeing some losses there. What are your expectations then for 2024 based on some of the cuts we've already seen Meta making this year?
Yeah, I think it's going to be a combination of things. And you kind of point to three factors that really drive the operating expense guidance they gave, which was modestly better than expectations. Number one is just in general around headcount costs, facilities costs. I think there the message is, 2024 is going to continue to be another year of efficiency. That's number one. Number two is just on their capital expenditures. These are around, building data centers and buying servers and certainly graphics processors in the age of generative AI. I think there, what we learned on the call, which was positive, was that they've actually gained a lot more, they've covered a lot more ground with money they've already spent, I think, than people realized. And so they're not going to have to spend quite as much as people thought in 2024. And then the last one is metaverse. And I think there, we don't love the losses. Investors don't love the losses, obviously. They're clearly continuing to spend. But I think the takeaway, again, nets out positively in that Mark Zuckerberg and his team are clearly acquiescing to investors' desires to keep it more reasonable, meaning balancing the growth with that spend, and you're netting out to a still an attractive consolidated P&L.
And Brad, just quickly, we saw the Nasdaq fall into correction territory this week. The S&P also flirting with that at the moment. What do you think are the best tech stocks to earn right now, especially if we're bracing for further downside?
Yeah, I think you still have to largely point to the large cap space and the mega cap space. In the case of what we cover, I think Meta still stands out to us as the most. It's got the most company-specific drivers, both product-wise and sort of advertiser tool-wise, that they're rolling out over the next few years to gain share in the ad market, drive operating leverage, earnings growth at a reasonable multiple. So we definitely like that one. And then secondarily, Google has sold off, and so inherently there's a more attractive entry point than where we started the week. But I think in Amazon's case, there's probably more of an attractive upside opportunity to earnings over the next couple years, and so that one probably also has re-rate potential written all over it. In these moments, small and mid-cap companies have just been very difficult because they don't have the earnings support. They don't have the shareholder support to weather some of these more difficult periods in the macro. We like some stocks in more defensive areas. Web design would be an example. Wix would be a small cap company I would call out that we like. But aside from that, we have to be really selective because the investors right now are just so sensitive to any signs that the consumer might be slowing or small business might be struggling or what have you. It just makes it really tough and makes mid-cap internet filled with a fair amount of landmines.
I certainly appreciate you breaking that down for us and really the specifics of what people should be looking for. Brad Erickson, RBC Capital Markets Internet Analyst, thank you so much. Have a great weekend.
Thank you. Good to see you.
Well, after a year under Elon Musk's ownership, X, also formerly known as Twitter, is looking to venture into new avenues. According to Bloomberg, executives of X told staff that they see YouTube and LinkedIn as future competitors. Here with the latest and what this means for X, we have Yahoo Finance's Dan Howley. So Dan, more of a push into the X Everything app.
That's right, Rochelle. This has been kind of Musk's go-to for his plans for Twitter, X. I'm just going to call it Twitter because it's easier. And it's what he's been focusing on for some time. He went through, obviously, cut down the workforce, pulled out some features, added some features. He's messing around with subscriptions, not really sure how that's working out for them, but they're still dealing with the fallout from his initial $44 billion purchase. Sensor Tower gave Yahoo Finance some numbers yesterday, basically saying that post-acquisition era, September 2023 global mobile app downloads were down nearly 38% compared to October 2022. So there's a decline in app downloads. As far as advertisers, Sensor Tower said that 46 of the top 100 advertisers on X from October 2022 have completely stopped advertising U.S. ad spending on the platform. So there's obviously a lot still going on with trying to right that ship, but there's also this other conversation about where the app is going to go. And, I think this is, going to potentially become the super app that Musk wants this to be, similar to China's WeChat, where you can basically, it is a super app. There's smaller apps within this app that you're able to access. And so that's the idea here. I don't know if, at this point, anything can topple YouTube. X is having problems getting users to want to sign up or download. Twitter had that same problem as well. It's just, it's never been a behemoth like an Instagram or a Facebook or, a WhatsApp. And frankly, if there's an app that you could, see challenging WeChat as an everything app, it would probably be WhatsApp. But the idea here, though, is to turn X into an app that you can use for everything entirely. And it appears that he's on his way to trying to do that.
And WhatsApp does seem like the more natural transition to an everything app. But obviously something else that Musk is also reportedly dipping his toes into, the financial realm. What can you tell us there?
Yeah, it's not just the LinkedIn YouTube competition. This is according to The Verge. They say that Musk is looking to get into the financial industry via X. So according to this report, you would be able to essentially not need a bank account. You would just use X for payments and things like that. And that's a very WeChat style feature that is available to users who can access it in China. And so this is kind of I would say probably the bigger step than adding a YouTube or LinkedIn style platform to the app. The payment side would be the bigger portion. To become a kind of everything app, though, they're going to have to need buy-in from other developers to want to work with them and put additional capabilities into it. Yeah, I can't see them doing all of this by themselves, having 18 billion different types of, not literally, but 18 billion different types of capabilities in a single app. So, but this is probably the bigger step here. Also, the more difficult step. Don't forget, there's going to be a ton of regulation that'll have to go through to ensure that he can offer this kind of feature in X. But he has a time frame by the end of 2024, so we'll have to see.
Yeah, that'll be an interesting one to watch. I'm not sure if I want all my business out there on X, things like video calling, my finances, everything else. But he did say it would blow my mind if we don't have that rolled out by the end of next year. Perhaps a little too much overpromising. We shall see. Dan Howley, always appreciate your updates. Thank you so much. All right, taking a look now at today's trending ticker. Shares of diabetes device maker Dexcom rising after third quarter profit beat estimates. The company also raising its full year revenue guidance. Now, Dexcom is shaking off investor concerns that the rising popularity of new weight loss drugs, including Novo Nordisk's Ozempic and Wegovy, could impact the device maker's sales. Now, those fears had punished the stock year to date. However, Dexcom, much like Abbott, calming investor fears and setting a positive tone for the company's outlook. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance.
The Fed's preferred measure of inflation, PCE, signaling prices ticked up in September and consumer spending surged, keeping the pressure on the Federal Reserve ahead of next week's meeting. Now, markets are largely anticipating officials will keep rates on hold again, but the data raises the prospect of more rate hikes in the future. Joining me now is Peter Borish, Computer Trading Corporation CEO and President. Good to have you on the show here. So, I want to get your takeaway here because a lot of people are wondering, you have these consumers spending more. Is that a demand issue, though, or is it the fact that they're still battling with inflated prices and that's perhaps coloring what we're seeing with consumer demand?
Well, thanks so much for having me on another interesting day in the markets. One of the major issues that one has to think about is if you think rates are going up, if you think inflation is going to go up, you anticipatory buy because you want to buy now before prices rise. So that's a little bit of the conundrum that the Fed and policymakers have. Are we front loading growth, which we just saw a tremendous number in the third quarter, and that it's going to slow down, particularly if inflation slows? We've seen energy prices stabilize. Natural gas has been low for a long time. We're going into a winter. We're here on the East Coast, obviously above normal weather. So all those things play into effect. But I think the most important issue is interest rate cycles are very long, and we're in the early stages, and it's likely that market rates are going to go higher for longer, regardless of what the Fed does.
So then do you think this latest inflation print, how much does that move the needle into the types or the pace of rate hikes that we might see going forward at the end of the year?
I don't think it moved the needle very much. I think you have to step back and say historically, unless there are major economic changes, the Fed does not like to sort of make policy decisions in the middle of a presidential election year. So we have a narrow window. The market does not anticipate anything happening next week. But if we have these strong consumption numbers, and we'll have obviously the inflation numbers, PPI, CPI, before the next Fed meeting, it's probable that they will do another rise in the front end. Now, the irony is, of course, if the yield curve goes back to normal, that's going to push the 10 years towards 5.5. And of course, remember, in interest rates, just like equities, it's never a straight line.
Indeed, and we've seen the 10-year flirting with that 5% mark. Currently has pulled back, though, but still edging up a little bit more today. What does that mean in terms of the multiples that we're seeing with equities? How should investors be gauging this period?
That is the question, isn't it? It's a challenge because there's the tug of war between economic growth, which we saw, which is good for equities, and the opportunity cost of higher interest rates, which is a challenge. So in the short run, I think that, equities after this correction will stabilize a little bit, at least into, my crystal ball gets foggy really early. So at least into the unemployment number next week and maybe into, the election on the first Tuesday of November. And then it's going to be tricky if rates start to accelerate.
And as we talk about correction territory, we saw the Nasdaq fall into that, S&P flirting with it. What are your expectations for how that's going to roll out for the rest of the year here if things do stay at this current pace?
Well, I enjoy these sort of arbitrary numbers defining a correction or not a correction. I think as many of your analysts who've been on here have looked beneath the surface and they've seen some weakening, particularly in the broader market as it reflects the Russell. So now, again, we have another tug of war, seasonal fourth quarter strength versus the potentially slowing, as we said, if the Fed raises rates one more time, of the economy. So personally, I tend to look at sort of leading indicators. And right now, one of the strongest stocks has been NVIDIA. And NVIDIA has been sort of holding right along that August low. If it significantly breaks that August low, then I think that portends weakness for the market in general, right? When the strongest start to act weak, that's when you have issues. It's holding it right now. It's up today. I think it could bounce, and that's why I think the market could bounce for the next 10 days.
And what are some of the risks you think the markets are not pricing in correctly? I mean, especially when you factor in how earnings season has gone so far, but then you balance that with some of this macro data that's coming out.
So I think the biggest risk that the market is not pricing in is the fact that we could have a little bit more of a spike in the longer end of the yield curve because of supply and demand dynamics. We have a situation where China is not buying our treasury bonds. We have a situation where so far Congress has not addressed at all some of the fiscal imbalances. We're going into that middle of November period, which is why, if you noticed, I haven't said we're going to rally past the first week of November. It's basic supply and demand. If you have a lot more supply and less demand, that means prices are going to go down. In the case of interest rates, price go down, yields go up.
Indeed. Well, appreciate you taking the time to join me this morning. Peter Burish, Computer Trading Corporation CEO and President. Have a great weekend.
You too, with pleasure.
Thank you. Well, paychecks for fast food workers in California are getting a little bit bigger. Starting next year, the minimum wage will be lifted to $20 an hour. So what does this mean for restaurant chains in the state? Yahoo Finance's Brooke DePalma joins me now with more. It's always a double-edged sword. It's good news for workers, but then you have a lot of restaurants wondering how are we going to meet these costs?
Rochelle, a double-edged sword indeed. Great for the workers, but hard for the companies to figure out. And the reason behind this minimum wage increase is because of the FAST Act going to effect. Now, that stands for Fast Food Accountability and Standards Recovery Act. It does go into effect on April 1st, 2024. And as you noted, it will bring the minimum wage for restaurant workers up to $20 per an hour. Now, it is important to note here that it is for companies that have at least 60 locations nationwide. And one of those chains that is going to be impacted in a big way is fast casual chain Chipotle. They have roughly 400 locations in the state of California. That's roughly 15% of its portfolio. And CFO Jack Hartung did note that this state is where they have more restaurants than any other state, making the FAST Act something that they're going to have to tackle directly. Earlier today, CFO Jack Hartung weighed in on how the company is preparing for it.
We tend to pay higher wages than others. Our average wage in California is about $17. To get up to 20 as the minimum. Keep in mind, when the average is 17, you've got some below, some above that. To get the minimum to 20, we're going to have to raise wages across the board by somewhere between 17, 18% up to 20%. Significant increase. Our plan is we have no choice. Every restaurant company in California is going to have to do this. We're going to have to raise prices. We've said that. We've not made a decision. We'll wait till we get closer to the April timeframe. But we'll have to raise prices somewhere in that mid to high single-digit range.
And he went on to say that despite this, the company will continue to build locations in the state of California, saying that the company does really, really well in the state of California. He also added that he believes that Chipotle pricing will still be about 10 to 30% below other restaurant chains in the state.
So then, Brooke, speaking of the others, what are some of the other restaurants with exposure in California?
Yeah, Rochelle. Well, so many that come top of mind is Wendy's, McDonald's, Starbucks, Yum brands like Taco Bell, Pizza Hut, KFC, as well as others like Burger King and Domino's Pizza. But one caveat that's important to note here is while Chipotle has a company-owned presence in California, so many of these companies that you see on the screen are franchise owned. And so ultimately, come April 1st, those franchise operators are going to have to tackle this issue about how exactly they're going to increase their wages and meet that new demand from California legislators. But it's also important to note that this FAST Act was opposed by many executives. Last August, McDonald's U.S. president called the legislation ill-considered and lopsided. He added that it would hurt everyone. And so it'll be really interesting to see how this all plays out and how franchise and companies at large look to tackle this new higher minimum wage in California.
Indeed, it will be interesting to see how that affects the bottom line when we get the next set of earnings after that goes into effect. Brooke DePalma, thank you so much. All right, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
touch points that she has is just remarkable. And it seems like you can't really replicate it. This is the pop star of our generation.
She's been in our news. She's been in financial news really throughout the summer. So if we take a look at a timeline of when we started seeing Taylor Swift, we know that Eras Tour really kind of started in the spring. So then it trickles into economic data into the summer. She was mentioned in the Fed Beige Book. Moody's called out Taylor Swift. There was a question to Fed Chair Jerome Powell about the Taylor Swift impact. And then Morgan Stanley highlighting at the end of the summer that the end of the Eras Tour is going to mean slower consumption.
I don't think there's ever been a concert film like this ever before. It's definitely a milestone kind of in the history of cinema in terms of excitement around a concert movie.
These are two of America's biggest entertainment brands with an opportunity to cross over. Why not? Why not lean into it? Why not have fun with video, image, and photos of Taylor and Travis Kelce's mom suite? I mean, that's great. So they definitely realize this is a growth opportunity for them in the audience in a way that maybe men 18 to 34 are not.
We did see a fairly substantial rise for the jet ski, and it was one of our top-selling games of the year once the announcement was made that Taylor was going to be there. She brings a fan base of her own outside of the NFL audience.
One of the most important things about Taylor is that she cultivates an incredibly strong relationship, direct relationship with her fans. There are so many reasons for her fans to get really excited about seeing her. And you know, with 150 some shows across the world, you know, we're just starting to see the real impact.
She's cultivated a community, not just fans who like the music, but a group of people who self-identify by their membership in the community, i.e. the Swifties. And her personhood becomes a way by which they represent their identity. That's super powerful.
Oil and gas producers Exxon and Chevron saw profits jump in the third quarter as oil and fuel prices climbed, but remain lower year over year. Now, both companies turned to the task of closing major acquisition deals, Chevron purchasing crude oil company Hess and Exxon to buy shale giant Pioneer Natural, both companies doubling down on investments in fossil fuels, despite warnings from the international energy agencies of declining oil demand. Let's bring in Lippau Oil Associates President Andy Lippau to get his view on the sector. Good to have you back on the show, Andy. So give us an idea on this move to have these oil mega mergers at this point in time when the demand picture still is not clear. What are your takeaways from this?
Well, good morning, Rochelle, and thank you for having me. What we're seeing is a trend of mergers continuing throughout the oil patch as these big producers are flush with cash and they're looking for places to invest it. Even though the International Energy Agency is forecasting peak oil demand by 2030, that doesn't mean that oil demand is going to fall off a cliff in 2031. What these majors are looking at is it's difficult to find new areas of the world to replace existing reserves to satisfy this demand going forward in the future.
And so with that in mind then, especially when you have a backdrop of geopolitical tensions, a lot of wonders about China's demand picture as well, is this the right move at this time?
Well, I think these major oil companies are feeling this is the place where they get the best return on their investment, and it's in an area that they know what they're doing. For example, Exxon is buying Pioneer, and Pioneer has very good acreage throughout the Permian Basin, and Exxon is going to use its improved technology to get more oil out of the ground in conjunction with that acreage to make that investment pay off.
And I mean, so with that in mind then, when you talk about the future of fossil fuels, obviously you see a lot of companies also still making investments in green energy then. So what does that mean for the future of fossil fuels, not just demand, but also on the supply side, and who's really going to be buying this?
Well, the supply side is really the difficult thing to come up with. Most supply reserves are really in the Middle East or in Venezuela, and in several other countries where U.S. oil majors and other integrated majors would rather not invest. While we go forward and we talk a lot about clean energy, the question is, can clean energy be delivered to the consumer at a cost-effective price compared to fossil fuels? Fossil fuels are going to continue to grow in demand in places like India, Southeast Asia, Latin America, or Africa that certainly don't have the infrastructure, if you will, to support the rollout of electric vehicles in a grand way, as they're still wrestling with providing electricity for day-to-day consumer needs in their homes.
Indeed. I mean, and when we look at some of the volatility that we've seen most recently in oil, started ticking up at the beginning of the Russia-Ukraine crisis. Didn't see as much of an impact following the Hamas-Israel conflict, though. But where do you see oil prices going from here? And what's going to be the next catalyst?
Well, I think that oil prices will continue to drift on up. I think you need $90 a barrel for WTI in order to encourage the next tranche of drilling, especially onshore as well as in the Gulf of Mexico. We've seen the drilling rig count come down over the last year. It's down about 19%, which means the oil majors are trying to do more with less expenditures. I think the catalyst for the next move up is actually twofold. One is the continued decline in worldwide inventories that's being precipitated by the voluntary production cuts that we're seeing out of Saudi Arabia and Russia. And of course, geopolitically, the oil market is watching the events in the Middle East to see if Iran gets drawn into the conflict directly. That presages a potential shutdown of the Strait of Hormuz, where nearly 20% of the world's oil transits on a daily basis.
And of course, one of the notable moves we saw this week, Warren Buffett upping his bet in Occidental Petroleum. What's your take on that, especially given how energy has fared so far this year?
Well, certainly it's a bet on price. Occidental is a huge producer here in the United States, and its stock price is really going to follow increases or decreases in crude oil and natural gas prices. And Warren Buffett is saying, oil demand is going to continue into the foreseeable future. And while it might be declining here in the U.S. or have been peaked, the world continues to require more and more oil. And you do see that in the short term with the International Energy Agency forecast for increased demand this year and next year, as well as OPEC Plus's forecast for increases in demand over the next few years.
And so then as we look at the industry here, are more mergers and acquisitions, do you think, coming down the pipeline? No pun intended.
Well, I think they are. These two latest acquisitions and mergers, Exxon with Pioneer and Chevron and Hess, are continuing a trend. When we think about going forward, Devon Energy and Marathon Oil have been reportedly in talks in a merger valued at $17.5 billion for Marathon. On the natural gas side, we're looking at Chesapeake Energy as well as Southwestern Energy and another $12 billion acquisition. That leaves Occidental and Diamondback really as independents remaining in the Permian, and perhaps they're going to either acquire someone or be acquired as we just see the oil industry consolidate.
That'll be an interesting industry to watch there, to see more consolidation in this space and where it goes. A big thank you there to Lippow Oil Associates President Andy Lippow. Thank you so much.
Thank you.
All right, time now for our chart of the day. According to a newly released report from S&P Global, mergers and acquisitions haven't had such a great year. Globally, over 8,700 deals were announced this year. That's actually down 28.3% from last year. It also marks the first time since the pandemic that the quarterly M&A count is less than 10,000. In the US, the number of deals fell 31% year over year, bottoming at over 3,000. It was a faster decline than what analysts and investors saw in the first 2 quarters of the year. The downward trend can be attributed to a higher for longer interest rate environment, a weaker global economy, and with several other headwinds heading into the new year, like geopolitical tensions, it's not likely that the start of 2024 will be a more encouraging environment. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Consumer spending continues to be the main driver behind the robust economy. We heard from the big credit card companies in the last week. Visa, MasterCard, and American Express all reported growth in spending across their consumer bases in their most recent quarterly results, with some of the biggest upticks being in travel. Now, each company commented about the strength of the consumer. MasterCard CFO saying, quote, consumers are still exercising their comfort around their employment status with their spending. Visa mentioning they have seen resilient consumer spending throughout the year. And American Express commented that millennial and Gen Z consumers continue to be the fastest growing portion of our card member base. Still, each company recognized macroeconomic headwinds on the horizon. Here now with what we can expect for consumers going forward is Ted Rossman, Bankrate Senior Industry Analyst. Good to see you, Ted. So, as we've heard from some of these credit card companies here, what does this mean in terms of the strength of the consumer paying high prices, or is it really about strong demand?
I think it's really both. I think that it is shocking. People keep saying this resilient consumer spending, but it's so true. I mean, that drove a lot of the 4.9% GDP growth number that we got earlier this week. I think it continues to surprise people. Now, it's not all rosy. I mean, more people are taking on credit card debt, delinquencies are rising, prices are up. None of this feels good, but I think at the end of the day, the strong job market is fueling a lot of this growth. And I also think it's notable that there is still a surprising amount of cash and checks in the system. So companies like Visa and MasterCard are benefiting from this ongoing shift towards digital payment methods.
And you note in your notes here, normalization is the key theme on delinquencies. I think a lot of times because we were in such a low interest rate environment for so long, we forget what used to be normal for us. Break that down for us and what that means for what consumers can expect going forward.
I think this is where numbers can sort of play tricks because the more negative glass half empty kind of view would be, oh my gosh, delinquencies are shooting up. They're up 50% from their low. And then the other side of it is they were artificially low for a while. During the pandemic, a lot of people paid down debt with their stimulus money and they were spending less for a while and delinquencies were really artificially low. So I get the sense that the industry is not really alarmed by this rise. Even though it looks steep by some measures, it's really only back to 2019 kind of levels in terms of delinquencies. And some companies like Amex are even lower than that because they have a more affluent, credit-worthy kind of customer base. Last year was a record year for credit card signups, according to Equifax. The first 6 months of this year, which is the most recent data that's available, that came within 1% of that record high. So credit has tightened a little bit, but not overwhelmingly so, not by a long shot. I mean, most people are still finding it easy to access credit. They're keeping up with the bills. Yes, balances are rising, but at least people are paying them back.
And you do raise an interesting point here because credit quality and risk was something we weren't sure what was going to happen, especially after all the banking fallout for regional banks earlier this year. But you're seeing that as being really resilient. At least banks are feeling good about this at the moment.
They are. I mean, honestly, from a bank standpoint, this is almost the best possible environment. This is a kind of Goldilocks scenario because balances are up, spending is up, debt is up, interest rates are up, and yet people are actually paying this money back. That's the big fear, is that what if there are a lot of delinquencies and defaults? I mean, honestly, the banks make a lot of money off of credit card interest. So the more that people carry balances, provided they actually pay it back, that's a real sweet spot for them. A company like Discover really relies on these so-called prime revolvers, people with good credit, who are good credit risks, who tend to carry balances at higher rates. Different companies have different strategies. Amex is more about the transactors, the big spenders who pay in full but pay annual fees, and Amex gets interchange revenue from merchants. So there's kind of different schools of thought on this, but I really think the credit card industry is having a strong year.
And in terms of what people are actually taking on that credit card debt to buy, it's different if you're sort of buying it on big ticket, fun items versus your necessities, like your groceries and your must-haves. What is that telling us? What picture is that painting for us about the kinds of debt that people are taking on?
This is kind of the K-shaped economy in a nutshell. We have some people doing quite well, and they're financing pricey trips to Europe and hopefully paying them off right away. And getting the rewards. And that's a very different scenario from somebody who's using a credit card just to make ends meet. And we're seeing that as well. We're seeing more people putting day-to-day necessities like gas and groceries on cards. And that's a tough situation. The fact that about half of cardholders carry debt from month to month, it's 47% to be technical. That's up 8 points from 2 years ago. And 60% of these people have had their debt for at least a year. And that's up from 50% 2 years ago. So it really is the proverbial tale of two cities here. People who use cards for rewards and convenience versus people who are using cards as really a day-to-day financing mechanism. And that's where those 20% plus interest rates really become a tough cycle to break.
And at what point then do you think we're going to see that really feel in the consumer in terms of how they're spending in a higher for longer interest rate environment, when you do have this divergence between those who can afford to quickly put things on a credit card and paying back those versus those who are barely making it?
Higher for longer is definitely a key theme, and that's going to make it increasingly difficult, I would say, to pay off this debt, because there's a cumulative toll to month after month of high inflation, higher interest rates, maybe you've depleted your savings. My best advice for anybody with credit card debt is to take out a 0% balance transfer card. I'm actually really pleasantly surprised how generous these terms have remained despite the rising rate environment. You can still avoid interest for up to 21 months on a card like the Wells Fargo Reflect or the Citi Simplicity. So there is help out there. There are also a lot of reputable nonprofit credit counselors like Money Management International and GreenPath. I think, though, this gap will continue to grow because rates are not going to come down in a meaningful fashion anytime soon. So we're probably stuck with 20% plus interest rates for the foreseeable future on credit cards. That's where you need to bring it upon yourself to pay this down as soon as you possibly can.
Indeed, and certainly read all the small print before you sign on the dotted line. A big thank you there. Ted Rossman, Bankrate Senior Industry Analyst. Thank you so much.
Thanks for having me.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. We're just a few days away from Halloween, but it's never too early to start shopping for Black Friday deals. The popular sales event is weeks away, but major retailers are already getting a head start on marking down hot holiday gifts. For tips on how to get to score the best deals this Black Friday, it's Michael Hirschfield, a Cruise Savings founder and CEO. Thank you for joining us this morning. So how can we get the best deals? And more importantly, how How can we get them debt-free, if possible?
It's a great question. I think that the number one thing is really important as we enter Black Friday is everyone should create a list before the day. There's always anxiety and excitement about the day, Cyber Monday as well, and you might overspend. And so it's really, really important that there is a list, that you know your budget. So when you see those emails coming in your inbox or you're on a particular website that you love, that you're not overspending. That's the anxiety and excitement of the day. And it's also really important for you to choose your payment service properly and appropriately. Your guest that just came on spoke about it very particularly. Interest rates are at an all-time high, particularly around consumer credit cards. And so a deal doesn't look like a deal if you can't pay your active credit card right away. 20%, 25% interest rates on your credit card, that could really hurt individual consumers' bottom lines. And so that 30% savings on Black Friday could really be impactful and negative as you enter January and February of the following year and Christmas starts to wane.
And so, Michael, are the deals really as good as they seem? We're seeing some of the deep discounting already starting. It feels like the holiday season is now extended into sort of early October all the way through the new year. But are these actually good deals, or is it just markups that sort of disguised as good deals?
The psychology of the retailer. They might not be great deals. And that's why it's really important that consumers triple check many different websites before they hit buy on a purchase. There are all ways that when a product is designed, when retailers design their websites, that it makes it feel like there's a huge markdown. But it's vital that consumers know they have more power than ever. They can open up another tab. They can open up another 10 tabs. Go to another website, look for that product, and understand that it might be cheaper somewhere else, and not to be lured by the wow factor of a particular design of websites trying to tell you that a great deal or that notification on your app is telling you to buy right away.
And one of the tips that you have on here, research and compare prices. Are there certain tools that work better than others for doing this? Because I'm the person who have a million tabs open and I'm checking all the coupon codes and everything else to try and get the best deal.
Well, there's nothing like Google. I mean, obviously, there's lots of different products that you could install on your browser, but the human mind and the ability to research is better than ever. I think if we're looking for an electronics, there are lots of different websites. You can actually search the particular product that you're seeing the deal for. Go into Google, search the name of that product, see what other websites are selling it at. That 5 minutes of research could save you hundreds of dollars. And it's important. Consumers have to be careful. There is a K-shaped recovery. Americans have $5,000-6,000 in credit card debt right now that they're sitting on. The idea of taking on more and the cost of credit now is harder and harder for consumers to tackle, especially if we continue to see rising inflation.
I mean, I know that I'm probably going to be pulling back on my spending this holiday season. I feel like I got most of what I needed or gave most of what I wanted to over the pandemic years, and now I'm just kind of like gift cards and other things. But in terms of tips, one of the things you recommend, limiting your screen time when you're looking for some of these deals. Break that down for us.
You know, the addiction on our phone. We're on Instagram, we're on TikTok, we're seeing what other people are doing, we're getting push notifications. We are drawn to engage with the content that's being distributed to us, whether it's social or e-commerce related, retail related. Putting down your phone improves your mental health, but it also likely means that you're going to spend less. When you're not opening every single email that's being sent to you by the retailer that you love, you're likely to buy less things. It's vital that you use the power of your own control to just not open those emails. Put your phone down, go for a walk, go for a run, do something different on Black Friday. And it narrows back, it rounds back to the have a plan. Have a plan for Cyber Monday. Have a plan for Black Friday. Know what you need and don't get lured into buying things that you don't want, that you don't actually need in your life that might actually impact you down the road as you're paying back things that you can't afford.
It's true, because we are getting inundated, especially with text messages, a million different ways that a lot of these companies are trying to get to us and get to our dollars. But in terms of the things that we should perhaps be buying now versus on Black Friday or Cyber Monday or waiting till New Year's, how do you break that down as to when is the best time to get certain products and things and services that you might want to buy?
Well, every year, I mean, obviously, the last couple of years we've had supply chain issues. So there's been real inflation that's occurred on certain products. So there is and we don't know what supply chain issues or oversupply certain retailers have in the market. So it's very important that consumers today start educating themselves on what the prices that the retailers they like shopping at are selling the things that they want. And so as you go through your own budget, make sure that you educate yourself on what prices are today and whether or not electronics are tremendous buys during Black Friday and Cyber Monday. That's a great product to buy on that day. You do see an uptick on prices after those days related to electronics. But other items like toys don't necessarily see deep discounts on Black Friday and Cyber Monday. So it's very, very important that if you want to buy something for your kids for Christmas or Hanukkah or for a holiday season, to make sure that you are finding the right retailer rather than being lured by the push notification you're getting on your phone or that email that you've gotten in your inbox.
The psychology of spending. They know what they're doing. Appreciate you joining me today. Michael Hirschfield, a Crew Savings founder and CEO. Thank you and have a great weekend.
All right, great to see you. Thanks so much.
All right, we're watching shares of GM right now. The automaker could be nearing a deal with the UAW, according to several reports. Negotiations are underway today after intense talks Thursday. Both GM CEO Mary Barra and UAW President Shawn Fain reportedly participated in those marathon sessions. Tentative agreements would likely mean the end of 6 weeks of targeted strikes by the union. A reminder that Ford reached a tentative deal earlier this week with the UAW. Union leaders will meet on Sunday to vote on that measure. As you can see, though, for now, at least today, big three automakers under some pressure this morning. Well, that does it for now. I'm Rochelle Akufo. Have a great Halloween and a wonderful weekend. See you then.